Hello everyone, welcome to EduTap and welcome to today's Maha Marathon session, which is going to be very important for your RBI Grade B 2026 Phase 1 examination. So, this is your Maha Marathon session for the RBI notifications and press releases and for the finance current affairs. Okay, and in this Maha Marathon session, we are going to discuss multiple MCQs. There are 100 plus MCQs that we are going to discuss in today's session, and through these MCQs, we are going to discuss the important facts that you have to remember from the examination perspective. Okay, so we are going to focus on the RBI notifications and the RBI press releases of March, April and May, but for Jan and Feb also, for from the most important articles, I have brought a few MCQs, like 20 plus MCQs, that will help you. Okay, so we will start with the most important articles of Jan and Feb. If you have covered Jan and Feb of the RBI notification and RBI press releases, then you can answer it, answer the questions. Otherwise, these questions will help you to understand that okay, these are the important facts, and if a question comes, that will help you, because that question will be from the most important data point. Okay, next we will start with the questions. After 20 questions, we will start with the questions of March, then April and then May, and from June also, like the recently Monetary Policy Committee meeting has happened. So from that, from the account aggregator SRO also, I have brought the questions from the June 1st to 5th. Also I have brought the questions. Okay, from the annual report also, there are certain questions. From the payment system report that is recently released by the RBI, from that also the questions will be here in this session. Okay, so that I can so that you can see that how much coverage you have done and what are the important data points that you have to focus on, what are the most important data points. Okay, then we will also discuss the finance, like we will also discuss the MCQs from the finance current affairs. Here, finance current affairs, the focus area is May, April and March only. Okay, so for the finance current affairs, the focus area is March, April and May only. Okay, and the MCQs are from the March, April and May. So give me a thumbs up if I'm clearly audible and everything is fine. Good evening everyone. Good evening all of you. Okay, so let's start with the session. Are you ready for the questions now? Give me a thumbs up, give me a fire sign if everyone is ready for the MCQs now. Let's start with it. Okay, chalo. Let's see the first question now. So this is the question in front of you. Try to answer this question. So as I've told you that first we will start with Jan and Feb articles, and the most important articles of Jan and Feb, they are from those most important articles. The MCQs are here, but only up to 20-25 MCQs are there from Jan and Feb. Then we will holistically focus on March, April and May articles of the RBI notification, RBI press releases. Okay, so with reference to RBI non-banking financial companies concentration risk management amendment directions 2026, consider the following statements regarding classification of lending to high quality infrastructure projects. Which projects are considered high quality infrastructure projects? The project should have completed at least 1 year of operations after achieving the date of completion of commercial operations. The project must be classified as standard asset. Correct. The lender should be strongly protected through an escrow account or trust and retention account. Correct. Revenue flow of the project should be protected for the whole contract period. This is also correct. Okay, so here the first statement is wrong, the second, third and fourth statements are correct, and that's why the right answer here is C, that is 2, 3 and 4. This is the right answer. Anyone who was able to give the right answer? D is the right answer. 2, 3 and 4. Okay, C is the right answer here. Okay, so the Reserve Bank of India, see, the first statement is incorrect because it is not 3 years, it is only 1 year of operations that is required. So high quality infrastructure projects are those projects that have completed. So high quality infrastructure projects are those projects that have completed at least 1 year of operations post achievement of the date of completion of commercial operations, classified as standard asset if they have protected revenue flow for the whole contract period, and if the lender is strongly protected through the following mechanism, that the money from the project is flowing towards the escrow account, that is the third party account, or the trust and retention account, so that it is clear that how the flows are being utilized, how the cash or the money is being utilized. Okay, so transparency is being maintained. Pari passu charge, that is, this means the lender has the legal claim on all the project assets like land, machinery, and equipment in case of default. Early termination safeguards are also provided. Okay, so in this case, the project is considered high quality infrastructure project. If a project is considered high quality infrastructure project, then where the borrower has repaid at least 2% of the sanctioned project debt shall attract a risk weight of what percentage? Shall attract a risk weight of what percentage? So high quality infrastructure project, if the risk weight, if the borrower has repaid 2% of the sanctioned project debt, so the risk weight will be how much? 75%. Okay. In case the 5% of the sanctioned project debt has been repaid, in this case, what will be the risk weight? What will be the risk weight? 50%. Okay, so this is the idea. So remember this, that the borrower has repaid 5%, at least 5% or more than that, then the risk weight will be 50%. If the borrower has repaid 2%, at least 2% or more than that, then the risk weight will be 75%. Okay, so 5% and more than that, risk weight 50%. Now coming to the next question. With reference to the Reserve Bank of India Priority Sector Lending Targets and Classification Amendment Directions 2026 issued in January 2026, consider the following statements. Bank credit to National Cooperative Development Corporation for on lending for further lending to the different cooperatives or for the development of different areas. This is eligible for priority sector lending classification up to up to 5% of the bank's total PSL of the previous financial year. Is it allowed? So if the bank is providing the credit to the National Cooperative Development Corporation uh, for on lending for further lending for the development of different areas, then this is eligible for PSL classification up to 5% of the bank's total PSL, and bank shall not levy loan related charges on priority sector loans up to 50,000. NULM, that is National Urban Livelihood Mission beneficiaries, have been included under the weaker section category? No. So first and second statements are actually correct. The third statement is incorrect because the National Urban Livelihood Mission beneficiaries, they have been excluded under the weaker section category, from the weaker section category. Okay. So first and second statements are correct. The third one is incorrect. And that's why here is A is the right answer. Very good, everyone. So basically, for the small finance bank, the priority sector lending target has been reduced from 75% to 60%. This is another important data that you have to remember. Urban cooperative banks can give PSL loan up to 12 crore per borrower to build healthcare facilities in a city with a population of less than 1 lakh. The beneficiaries under NULM have been excluded from the weaker section category for the purpose of PSL. Okay. Now, next is NCDC, that is if a commercial bank other than RRBs, UCBs, small finance bank, local area banks, if they sanction a loan, so if the commercial bank other than these sanctions a loan to the NCDC uh, on or after January 19, 2026, and this loan is used for on lending to the cooperative societies for the development purpose of the agriculture and MSME, then this loan can classify as PSL, but it is only up to 5% that a commercial bank can provide in this area. No loan related charges and other ad hoc charges can be levied on priority sector loans up to 50,000. Okay, so no loan related charges and other ad hoc additional charges, they cannot be levied on priority sector loans up to 50,000. Now coming to the next question. Prior to RBI's prudential norms on capital adequacy amendment directions 2026, ratings assigned by which entity were permitted only for risk weighing claims on non-resident corporates originating in IFSC? So for which entity was only allowed to provide the ratings, or which entity ratings were only used by the banks for the non-resident corporates originating in the IFSC? So this particular entity, the RBI said previously, the RBI had said that this particular rating agency, if it is providing the rating to corporates or to the non-resident corporates in the IFSC, then the bank can use this rating for the risk weight classification. Now what has happened, that this kind of restriction has been removed, and it is said that the NRC, that is non-resident corporates of anywhere, they can take the rating of this entity which the bank can utilize for the risk weight. Okay, so before, this kind of limitation was on the CareEdge Global IFSC Limited. So the claims on non-resident corporate shall be risk weight As per the ratings of the international rating agencies, earlier the RBI allowed ratings by CareEdge Global IFSC Limited to be used only for risk weighing the claims on non-resident corporates originating at IFSC. But now this kind of limit has been removed. Okay, so claims on non-resident corporates risk weights mapping for the ratings assigned by CareEdge Global IFSC. So before the limit was there, but now it has been removed. So for all the non-resident corporates, the banks can use the rating provided by the CareEdge to provide the to decide the risk weight. Okay, now risk rating status of claims. If the claims are unrated and the claim is of more than 200 crores, then in this case the risk weight will be 150%. If the claim were previously rated, now it is unrated and the claim is of or exposure is of more than 100 crores, then the risk weight will be 150%. Now payments regulatory board. So the meeting happened, the first meeting of the payments regulatory board happened in January 2026. So try to answer this question, because like your monetary policy committee, which is very important from the examination perspective, similarly payments regulatory board is also very important from the examination perspective. So try to answer this question. Anyone who is able to answer this question? So payments regulatory board was constituted after an amendment in the Payment and Regulatory System Act 2007. The board shall ordinarily meet at least thrice in a year. The quorum for holding a board meeting shall be 3 members. A person who is member of parliament or any state legislature cannot be nominated. So the first statement is correct. Second is incorrect, because instead of thrice, it should be twice. It should be twice. Okay. So the board shall ordinarily meet at least twice in a year. At least twice in a year. And the quorum for holding a board meeting shall be 3 members. A person who is a member of parliament or any state legislature cannot be nominated. So third and fourth are correct. First, third, and fourth are correct. And that's why here the answer is C. Why some of the students are saying E? Third is also correct. Na? The quorum for holding a board meeting shall be 3 members. 3 members should be present. Okay. So C is the answer. So here payment regulatory board, the first meeting of the payment regulatory board happened in January, and the board members are the governor of the Reserve Bank of India, which is also the chairperson of the payment regulatory board, deputy governor in charge of the payment and settlement system, executive director in charge of the payment and settlement system, secretary of the Department of Financial Services, secretary of the MeitY, Srimati Aruna Sundarajan. These are the 6 members of the payment regulatory board. Okay. Now, the payment regulatory board, the members, out of the 6 members, the 3 members are from the Reserve Bank of India, while the other 3 members, they are nominated by the government of India. The people that are nominated by the government of India for the payment regulatory board, they should not have completed the age of 70 years on the date of appointment as the member. Okay, as well as they cannot be the member of parliament or any state legislature. They should not have been convicted of an offense which is punishable with an imprisonment of a term of 180 days. Now board shall ordinarily meet at least twice in a year, not thrice. It is twice in a year. The quorum for holding a meeting of the board shall be 3 members and shall include the chairperson. The meetings of the board shall be presided over by the chairperson, and in the absence of the chairperson, that means if the governor is absent, in that case the deputy governor can take over as the chairperson for the presiding of the board meeting. That's it. Okay. The member of the board that is nominated by the central government can hold the office for the period of 4 years, and they are ineligible for re-nomination. Chalo, now coming to the next question. The Supervisory Data Quality Index, introduced by the Reserve Bank of India for scheduled commercial banks, evaluates the quality of supervisory data submitted by banks based on which of the following dimensions. Now in this particular case, see, the Supervisory Data Quality Index, it is now released on the quarterly basis. In the annual report also it was mentioned that from June 2025, the Supervisory Data Quality Index, it is released on the quarterly basis, and this informs about the data quality data quality regarding the data that is sent by the regulated entities to the RBI, that how good the data is, how trustworthy the data is, how accurate the data is, how complete the data is, how consistent and in the timely manner if the data is being sent. So Supervisory Data Quality Index, introduced by the RBI for the scheduled commercial bank, evaluates the quality of the supervisory data on these parameters: accuracy, timeliness, completeness, and consistency. Okay. So now supervisory data quality index for the scheduled commercial bank December 2025, it was actually released in March, though it is the quarterly data, so you do not have to focus on it much. So this was released in March 2026. Okay. Here you can see that for the scheduled commercial bank, the supervisory data quality index score has improved from September 2025 to December 2025. There is the improvement in the supervisory data quality index. Okay, for the scheduled commercial bank. For the public sector banks, the quality has reduced slightly. For the private sector banks, the quality is same. For the foreign banks, the quality has improved. For the small finance bank, the quality has improved. Okay. So what is the value of the December 2025 supervisory data quality index? It is 90.9. Now this is the updated data that was released in March 2026, though it is quarterly data, so you have to focus on it less. Okay. Now supervisory data quality index, as per this data, here you can see that now previously there were zero banks within the range of between 70 to 80 that is needs improvement. So there were zero banks in this range. The banks were in the acceptable range or the good range. All the banks in the scheduled commercial bank category, they were in the good category or acceptable category, but now two banks have come into the needs improvement category. Okay. The timeliness and completeness, here you can see that from the previous supervisory data quality index, the timeliness and completeness, these parameters, they have shown slight reduction, while the accuracy and the consistency has improved. Now coming to the next question, try to answer this question. The Reserve Bank of India has recognized um, the Reserve Bank of India has recognized Dash as a SRO for authorized dealers. The shareholding of the SRO should be sufficiently diversified and no entity shall hold Dash or more of the paid up equity capital, share capital, either singly or acting in concert. So which of the following has been recognized as a SRO for the authorized dealer? It is FEDI that has been recognized as the SRO for the authorized dealer, and the shareholding of the SRO, no entity shall hold 10% or more than 10% in the SRO. So B is the right answer here. Very good, everyone. Now, moving forward, there was also the RBI has granted in principle approval to Sumitomo Mitsui Banking Corporation, Japan, for the wholly owned subsidiary in India. So, if a question comes, though it was in January, so very less chances. But just remember that Sumitomo Mitsui Banking Corporation in Japan has got the in principle approval to open the wholly owned subsidiary in India. Okay. Now, coming to the next one, the theme of the Reserve Bank of India's report, State Finances, a study of budgets of 2025-26, is what? So the theme of the RBI's report, State Finances, a study of budgets of 2025-26, is which of the following? I have taken a detailed session on this report also, but here the theme is very important. So the theme is demographic transition in India, implications for state finances. Very good. So Damini, very good, Damini. So C is the right answer here. And the Reserve Bank of India has this public annual publication, State Finances, a study of budgets. The theme was demographic transition in India, implications for the state finances. Now it has shown that the demographic shifts are coming in the states, and in 2016 we have the youthful states or the intermediate states, but in 2026 there will be some states that will become that will come in the aging category. So in 20 by 2026, Kerala and Tamil Nadu are expected to enter the aging category. So that is the idea. And by 2036, however, more than half of the states will be aging and the rest will fall under the intermediate category. Now, coming to the next question, try to answer this question, that there is the MOU that has been signed between the Reserve Bank of India and the European Securities and Markets Authority. This will enable formal recognition of which of the following entities by the European Securities and Market Authority. So basically, this MOU has happened so that the European Securities and Market Authority, it recognizes the central counterparties of our country. Now, here NPCI, it is not a central count, like basically it is not under the SEBI regulations, or it is not uh, it is just a payment, like National Payment Corporation of India, SEBI, it is the regulator. NSDL, it is a depository, it is not a CCP. NSE, it is a stock exchange. So Clearing Corporation of India Limited, it is a central counterparty, and that's why A is the right answer. Okay. So RBI and ESMA, they have signed a MOU. It concerns cooperation and exchange of information in relation to the central counterparties, and that's why it will enable, this MOU will enable formal recognition of the CCIL. Okay. Now, coming to the next question, the RBI recently entered into an agreement to undertake the general banking business of which of the following governments with effect from January 9, 2026? So, the RBI recently entered into an agreement to undertake the general banking business of Government of National Capital Territory of Delhi. Okay. Yes, B is the right answer here. B is the right answer. So, the Reserve Bank of India provides short term financial accommodation to state governments and union territories. The general banking business of the Government of National Capital Territory of Delhi was earlier not handled by the RBI. The RBI entered into an agreement to handle the banking business of the GNCTD also, okay, with effect from January 2026. This is the idea. Now, the ways and means advances, do you know that for how many months? Like, I will be asking you the rapid fire question, so I hope you will be able to answer. Like, the ways and means advances have to be returned within how many days? What is the interest that is charged on the ways and means advances? And if there is overdraft, then for that, the interest rate will be what? Okay. So, ways and means advances, it is provided for, like, it has to be returned within 90 days. And the interest on the ways and means advances is repo rate, and the overdraft, for the overdraft the interest rate is repo rate plus 2%. Very good, everyone. Chalo, nice. Very good. The overdraft repo rate plus 2%. Next question is, recently RBI issued the Credit Risk Management Directions 2026 following modifications to the Credit Risk Management Directions 2025 that will strengthen and tighten the rules on lending by financial entities, especially lending to their related parties. As per the amended directions, a related person is an individual along with their relatives who is either a promoter or a director or a key managerial person of the bank or have significant ownership. So basically, related person is an individual along with their relatives if they have ownership of more than what percent of the paid up equity capital and voting rights of more than what percentage. So basically, ownership of more than 5% and and voting rights also of more than 5%. So C is the right answer here. C is the right answer here. Okay. It is not 5%, 10%, it is 5%, 5%. So related person, if it is an individual along with their relatives who is either promoter, director, key manager, person of the bank, they or have significant ownership more than 5% of the paid up equity, voting rights more than 5%, the power to nominate a director and such. Related party. Now, why you got confused here? Because related party or reciprocally related party is a partner, manager, key managerial person, director or promoter, or has influence or control or ownership holding more than 10% or for the paid up equity and 20% of voting rights. And this is in case of entity, not individual. So in case of individual, 5%, 5%, remember this. And in case of any entity where the person is like where the entity is related party or reciprocally related party, then the percentage should be 10%, 20%. So remember, in the case of individual, voting share and the shareholding, both 5%, 5%. In the case of entity, shareholding 10% and voting share 20%, voting rights 20%. Okay. So reciprocally related person in the case of urban cooperative banks will be the director of the other urban cooperative bank or cooperative bank. So director of other cooperative bank. So reciprocally related person means that the director of a urban cooperative bank, if it is related to the director of another cooperative bank, so that will be a reciprocal related party. Okay, that is it. Chalo. Now here there are many things that are given. Now whole of the materiality threshold that is given, I have given it in very small because you cannot remember this. Even if a question comes, you will have to leave it. Remember, 80 out of 80, you do not have to bring. This is not what you are targeting. You are targeting good marks. That will be 40, 45 maximum. Okay, so 80 out of 80 you don't need. You will not be able to remember so much of the data. So why take that effort? Why reduce your chances of remembering the other important data? So this you can forget. Just remember the related party and in case of individual, and the related party in case it is a entity. Okay, a related person in case of individual. So it is called related person, individual, related party when it comes to entity and such. Chalo. If you want to remember it, if you do not want to take any chance, you can, but I will normally suggest for the students to not focus on it. Chalo. Only up to 20 questions, 25 questions will be from Jan and Feb. Now, this is the end of the Jan. This is the last question from Jan now. Okay. With reference to the RBI Internal Ombudsman Directions 2026, which of the following statements is incorrect that you have to answer? So I hope you know about the Internal Ombudsman scheme, even though, I hope you know about the Internal Ombudsman Directions, even though Internal Ombudsman Directions were not in news last year, but still a question came from the Internal Ombudsman Directions in the phase one. So remember, now it is in, like it was in news, the new directions have been released. So this becomes important even if it is from January. So the tenure of internal ombudsman shall be at least 3 years, but cannot exceed beyond 5 years. So that is correct. The deputy internal ombudsman cannot be above 70 years of age before finishing the tenure. Correct. If the vacancy arises due to reasons beyond the regulated entity's control, the entity must inform RBI within 10 working days and appoint a new person within 3 months from the date of vacancy. Correct. Commercial banks, payment banks, small finance bank with how many banking outlets or more than that need to follow the directions related to the internal ombudsman? So having 10 or more of the banking outlets. So this is wrong. Credit information companies must forward such complaints that are partially rejected or wholly rejected for review within 25 days of receipt of the complaint. So all of the other statements are correct. The D is the incorrect one. Okay. So the commercial banks, payment banks, small finance bank with 10 or more banking outlets in India, they need to follow the directions. Non-banking financial companies, if they are deposit taking NBFCs with 10 or more branches, non-deposit taking NBFCs with asset size of more than or equal to 5,000 crore and having public customer interface, these NBFCs have to follow the internal ombudsman directions. Now, NBFCs excluded from the directions: housing finance company, core investment companies, infrastructure debt fund, infrastructure finance companies, non-operative financial holding companies, and primary dealers, mortgage guarantee companies. PPIs, if they have more than 1 crore prepaid instruments live, so they need to follow the internal ombudsman directions. The rest we have already, like I have also discussed this previously. So just go through the details. The data is important, that how much experience for the internal ombudsman, 7 years. How much experience for the deputy internal ombudsman, 5 years. Okay. So these are the things that you have to remember. Age limit cannot be above 70 years. Tenure at least 3 years, but cannot exceed 5 years. So this is the idea. And the fresh employment should happen at least 3 months before expiry of the tenure of the internal ombudsman. But in case of the immediate, like something happens, illness, death or something, then in this case RBI has to be informed within 10 working days and fill up the seat within 3 months. That is the idea. Chalo. Now coming to the next question, that is under the lending to MSME sector. Now we are moving forward with the Feb articles. Under the lending to MSME sector directions 2026 issued by the RBI, what is the enhanced limit for mandatory collateral free loans to micro and small enterprises? Try to answer this. Yes, 20 lakh. So this is the idea that under the lending to MSME sector directions 2026 issued by the RBI, the enhanced limit for mandatory collateral free loans to micro and small enterprises is 20 lakh. Before it was 10 lakh. Now the limit has been extended to 20 lakh. Okay. So this is the idea. Now, next is that recently the Deposit Insurance and Credit Guarantee Corporation implemented the risk based premium framework. Before this framework, banks were charged a flat premium rate of what? Yes. So, before this framework, banks were charged a flat premium rate of 12 paise per 100 rupees of the accessible deposits per annum. Okay? So this is the idea. Now it has been said that the DICGC, rather than charging a flat rate, the DICGC will moving towards the risk-based premium framework. Now, under the risk-based premium framework in the tier 1, which category of banks come under the tier 1 and which category of banks come under the tier 2? So, question can come that out of these categories of bank, the tier 1 banks are. So, let's say the small finance banks, commercial banks, regional rural banks, urban cooperative banks, the rural cooperative banks. So which of these five categories of bank come under the tier 1? So commercial bank and small finance bank, they come under the tier 1. Tier 2 consists of the regional rural banks, urban cooperative banks, and the rural cooperative banks. Okay? So this is the idea that tier 1 are the commercial banks other than RRBs, as well as small finance banks also come under the tier 1 category. Tier 2, RRBs, cooperative banks, urban cooperative banks, or the rural cooperative banks. Okay. In the tier 1, what are the three components according to which risk profile is decided? Supervisory ratings, quantitative assessment of the financial health through CAMELS parameter, and potential loss of the deposit insurance fund. The tier 2, the two parameters are quantitative assessment of the financial health through CAMELS parameters and potential loss to the deposit insurance fund, as well as for the tier 2 there is additional parameter, that is the non-financial criteria, that is the corporate governance parameter. For the tier 2 model, this is the additional criteria, remember this. Now, coming to the next question, try to answer this question. I hope you will be easily able to answer this question. Which of the following statements is or are incorrect in regards to the deposit insurance and credit guarantee corporations risk based premium framework? So try to answer this question. Local area banks and small finance banks will continue to pay the card rate as there are data point limitations to bring them into a risk based pricing model. Vintage. Now, why this is wrong? Because initially we discussed now that in tier 1, tier 2, like tier 1 model, there are commercial banks and small finance banks. So, small finance banks, they are included under the risk based premium framework. So, small finance bank will continue to pay the card rate? No, on the basis of their risk they will pay the rate, right? So here payment banks were not mentioned. If you remember, the RRBs were mentioned, UCBs were mentioned, small finance bank, commercial bank, rural cooperative banks were mentioned, but the local area banks and payment banks were not mentioned. So local area banks and the payment banks, they will continue to pay the card rate as there are data point limitations to bring them into a risk based pricing model. Vintage incentive for tier 1 banks can be maximum up to 25% for the banks operating for 25 years or more with a clean track record. So on the basis of your risk profile, you will get a score, you will get discount in the insurance premium. Okay, so if you are divided into tier 1, tier 2, so on the basis of the risk profile you will get certain discount, as well as there is vintage incentive, that how old you are, how much of the clean track record you had. Okay, so the maximum for the tier 1 banks, the maximum vintage incentive can be up maximum up to 25% for the banks operating for 25 years or more with a clean track record. The application premium based on the effective premium rate will be available on DICGC's Samyak portal at the start of the payment cycle. So this is correct, that how much premium you have to pay, how much premium a bank has to pay, this will be provided through the DICGC Samyak portal. So second and third statements are absolutely correct, and that's why the right answer is D. That is because we had to find the incorrect statement, right? So D is the right answer. That is one only. That is one only. Chalo. So here you can understand that on the basis of the risk profile, the banks are divided into A, B, C, D. The safest banks are under the category of A, B, C, D. In which category? In the category of A. And they get the maximum discount of 33.33%. While the banks that are in the worst situation, the most riskiest banks, they are in the category of D. And they have no discount. They have 0% discount. Okay. So this is the idea. Local area banks and the payment banks, they continue to pay the card rate of 12 paise per 100 rupees. Now tier 1 banks, they get the vintage incentive of maximum like 1% for each completed year with the clean track record, and maximum 25% for the 25 years. Okay, vintage incentive for tier 2 banks, that is applicable to RRBs, state cooperative bank, district central cooperative banks. State cooperative banks and the district central cooperative banks are the rural cooperative banks. Okay, tier 4 UCB. So it is not for tier 1, 2, 3. It is only for the tier 4 UCBs. So flat 25% discount, premium discount. This is the idea. Now, coming to the next question. Recently, RBI launched the Financial Literacy Week 2026 with which of the following themes? So, what was the theme of the Financial Literacy Week? What was the theme of the Financial Literacy Week? Anyone? The theme of the Financial Literacy Week was KYC, your first step to safe banking. This was the theme, right? So yes, B is the answer here because this was the theme. KYC, your first step to safe banking. This was the 11th edition. Now coming to the next question, that is with reference to the RBI's digital payment index, consider the following subparameters. So I hope you remember that this kind of question has come in the previous year also. So it's not only that the parameters you should be aware about, you should be aware about the subparameters where you don't have to do rectification. If you know that what the parameters are, you will easily be able to give the answer. Okay. So what are the parameters? Payment performance, payment enablers, payment infrastructure supply side, payment infrastructure demand side, and consumer centricity. The highest weightage is given to which parameter under the digital payment index? Which parameter has the highest weightage? Payment performance. Okay. So here the question is that which of the above are the sub parameters under payment performance. So payment performance by the name itself, that how well the digital payments are performing in the volume, in the terms of volume, in the terms of value, the number of transactions have increased, the value of transactions have improved. Unique users, that are the new users, that will also come under payment performance. QR code, does it not look like payment infrastructure supply side? Because in the QR codes, through that is the supply side payment infrastructure, right? So this cannot be payment performance. Cash withdrawals, if the cash withdrawals have reduced, that means more digital payments are happening. So all the other are the sub parameters under payment performance. So here 1, 2, 3, and 5 is the answer. So B is the answer. Very good. So basically, the RBI has been publishing a composite digital payment index since January 2021, and the base year for the digital payment index. What is the base year? Anyone who is able to answer, what is the base year for the digital payment index? It is March 2018. It is March 2018, and the value of the base year is 100. Okay. Now the data for the September 2025, the digital payment index has increased to 516. 516.76. Now if you remember in the annual report, it is said that in the previous financial year, there is the increase in the digital payment index by what percentage? There is the increase in the digital payments by what percentage? By 11%. This is something that you have to remember from the annual report. This is how you connect the things that you are studying about the digital payment index. You remember that in the annual report also you studied about it recently. So there is the increase of the 11%. Okay. Very good. Yoganshi. So these are the parameters. The weight, the highest weightage is payment performance, then payment enablers, then payment infrastructure supply side, then payment infrastructure demand side, consumer centricity. Payment performance, the digital payments, the volume has increased, value has increased, the new users, they have increased, paper clearing has reduced, there is less requirement of the check clearing and such. Currency in circulation has improved. The cash withdrawals, they have reduced because of the digital payments. The payment enablers, internet is required, mobile Aadhaar, your Aadhaar card, bank accounts, participants, merchants are required. Supply side, in the supply side, we have bank branches, ATMs, QR codes, POS terminals, intermediaries. Demand side, we have debit card, you have credit card, prepaid payment instrument and such. Okay. Consumer centricity talks about the awareness, education declines, complaints, fraud, and system downtime. Now, coming to the next question, try to answer this question. That which of the following statements regarding numerical eligibility and prudential limits under RBI Credit Facilities Amendment Direction 2026 is incorrect? So, try to answer this question. So banks can extend acquisition finance up to a maximum of 75% of the acquisition value. So let's say that one company wants to acquire another company. Okay, that is a non-financial company. So in this case, the bank can lend for the acquisition up to 75% of the acquisition value only. Yes, the acquiring company must have a minimum net worth of 500 crore at the time of sanction, even if it is a listed company or unlisted company. If it wants to get the acquisition finance, if it wants to get the loan from the bank for acquisition, it needs to have the minimum net worth of 500 crores. Absolutely correct. Listed acquiring companies must have reported profit after tax in the each of the previous 3 consecutive financial year. Absolutely correct. Post acquisition, the consolidated debt to equity ratio of the acquiring company must not exceed 3:1. So debt to equity ratio, that is debt to equity ratio, should not exceed 3:1. Okay. So this is wrong. It is not 2:1, it is 3:1. The acquisition of control over the target company must be completed within a maximum period of 12 months. So this is correct. So all other statements are correct, just one statement that was wrong. So acquisition finance, basically this shall mean a financial facility or assistance provided by the bank to an eligible borrower which wants to acquire a target company. Okay, or merger or amalgamation is happening and such. Now, acquisition finance, acquiring company must have a minimum net worth of 500 crores, must have the net profit after taxes, net profit that is after taxes, the profit that is left with the company should be, there should be net profit after taxes reported in each of the previous 3 consecutive financial year. Listed and unlisted companies, they both need to have these two criteria. But unlisted companies, they should also have the investment grade rating of BBB minus or above if they want to have the acquisition finance. Okay. Now, the bridge finance is allowed, but the bridge finance is allowed for a time period of 1 year only. That is within 12 months, the money has to be returned. So let's say acquisition finance, through for that you are getting 75% of the loan, 25% you are not able to gather the whole amount immediately. So you can get the bridge finance, that is for a time period of 12 months. Now, coming to the next question. 25th, after 25th. Chalo. Under the RBI, Small Finance Banks Credit Facilities Amendment Directions 2026, banks may grant loans to individuals against eligible securities. The aggregate amount of loan that may be sanctioned to an individual against eligible security shall not exceed how much to an individual. Now, see, credit facilities is important because update came in March. There was an update that was released in March or April. Even though these directions were released, this acquisition finance direction, this credit facility direction, even though it was released in February, but remember that for these credit facilities there was an amendment that was released in March or April. That's why these directions, they become important. Even though they were released in Feb, but they become important because there was amendment that was released in March, yes, 30 or 31st March, yes. So they are important. Okay, so aggregate amount of loan that may be sanctioned to an individual against eligible securities. Okay, eligible securities such as your shares and such. So shall not exceed 1 crore per individual within the above loan limit per individual at the banking system level. At the whole banking system level, loan up to dash can be provided per individual. This may be granted for the purpose of acquisition of securities in the secondary market. So up to 25 lakhs. Very good. C is the answer here. Okay. So here the RBI issued the credit facility direction 2025 and the amendment happened in 2026. Now these updated directions, sorry, the update happened in the directions, and these updated directions will commence, the commencement of amendment happened April 1, 2026. They were further amended in March also. Okay. So these are the securities eligible to extend loan. So bank can provide loan against the listed equity and preference shares, government securities, listed debt securities, units of mutual fund scheme, units of ETFs, investment trust and such. So here you can see that what are the criterias. I have already taken a detailed session on this, and I hope you have already gone through it. Like if you're going through the updates and such. Okay. Now, coming to the part, LTV ratio is also given, that loan to value ratio. If the collateral is, if the bank is providing the loan against the eligible securities collateral, so the loan to value ratio is as per these. Okay. So if the listed shares, listed convertible debt securities are there, that can be converted into the equity, into the shares. So the loan to value ratio is 60%. Mutual fund excluding debt mutual funds, unit of ETF, units of REITs and InvITs, they should have a maximum ceiling of a loan to value ratio 75%. Now, the amount of loan that can be granted to individuals against the eligible securities is capped at 1 crore per individual at the banking system level. And under this 1 crore limit, 25 lakh can be provided per individual, or this is the cap for the purpose of acquisition of securities in secondary market, or for the IPO, FPO also 25 lakh is the limit, provided that the loan amount shall not exceed 75% of the subscription value. Now coming to the next question. Now all credit facilities to CMIs, that is the capital market intermediaries, these are the stock brokers, the clearing members, the depositories, the depository participants. So the all credit facilities to the CMIs including intraday facilities, unless, so if the credit facility, if a bank is giving loan to these entities, even including intraday facility, unless otherwise stated, shall be provided on a fully secured basis. That means 100% collateral. So if bank is giving loan to these capital market intermediaries, there should be 100% of security. A relaxed percent of minimum collateral applies only if the intraday limit is where the QCCP, that is qualified central counterparty, is present for the trades that are happening, and the QCCP is guaranteeing. Okay, so then the relaxed collateral of 50%. Then the relaxed collateral of 50%. That is the idea. So you can read this. The most important point is that all credit facilities to CMI should be 100%, should be against the 100% collateral. When a bank accept equity shares as the collateral, then there should be a minimum haircut or a margin of 40%. A relaxed 50% minimum collateral applies only if the intraday limit or the intraday facility is there where the QCCP is also present. Okay? Now, coming to the next question, according to the RBI prudential norms on capital adequacy, irrevocable payment commitment issued by a bank to clearing corporation. So a bank is issuing the irrevocable payment commitment that if a trade happens, then the if the client is not able to pay, then the bank will pay, then the custodian will pay. In this case the credit conversion factor for the bank, the credit conversion factor is because the bank has provided the irrevocable payment commitment that if the client is not able to pay, then the bank will pay. So here the credit conversion factor is basically 100%, and the risk weight on this kind of like on the capital market exposure is, the risk weight on capital market exposure is 125%. Okay, so risk weight of on capital market exposure is 125%, while the credit conversion factor is 100%. Coming to the next question, just 2-3 more questions from Feb, then we will start with March. As per the RBI Commercial Banks Concentration Risk Management Amendment Directions 2026, the aggregate capital market exposure of a bank on a solo or consolidated basis shall not exceed what percentage of its eligible capital base. So bank is providing loans, the bank can also invest in the securities market, and the bank can also provide loan against the shares, against the debt instruments, against the mutual funds. So bank has direct exposure to the capital market because bank is investing in the securities market, in the capital market. So bank can have direct exposure or the bank can have indirect exposure. In both of these cases, even direct exposure is there or indirect exposure is there to the capital market, the maximum exposure can be 40% in total. Okay, so 40% is the answer. So in the capital market exposure, that is a bank's total capital market exposure must not exceed 40% of its tier 1 capital. A bank's direct capital market exposure shall not exceed 20% of the eligible capital base. Okay. Next is that if the irrevocable payment commitment is provided by the bank, then to see that for the shares, let's say the client wants to purchase the share, and for the client, the bank has provided irrevocable payment commitment that the payment will happen. If the client is not able to pay, the bank will be responsible. So in this case, the shares is taken at a risk weight of 125%, or capital market exposure has 125% of the risk weight. Now, how much is the exposure that can happen? So if the trade is initiated today and it will settle tomorrow, so the maximum risk weight that is considered is 30%. Okay, if the trade initiate today and it will settle after 2 days, so the maximum capital market exposure is considered 50% of the settlement value. Okay, so basically 20% per day plus 10% extra. 20% like for 2 days, 20% plus 20% plus 10% extra. This is the calculation. Now coming to the next question, with reference to the borrowing limit under external commercial borrowing framework notified by the RBI under the Foreign Exchange Management Borrowing and Lending Regulations February 2026, an eligible borrower may raise external commercial borrowing. So the eligible borrower can get external commercial borrowing up to what limit? As per the last audited standalone balance sheet, up to $1 billion or 300% of its net worth. Okay, so here like there are a lot of data points, but these are the most important data points that you have to remember. As well as a borrower shall raise ECB with minimum average maturity period of 3 years. When the borrower is engaged in manufacturing sector, they may raise external commercial borrowing with average maturity period between 1 year and 3 years, but then they will be able to raise not exceeding 150 million. That is the idea. So basically, if you're raising the money, you have to raise the money for a minimum period of 3 years, a minimum maturity period of 3 years. But if you are engaged in the manufacturing activity, then you can raise the external commercial borrowing, then you can get the external commercial borrowing for the period of 1 year to 3 year. But in this case, you can borrow maximum $150 million from outside. Okay. Coming to the next question, sorry. As per the Reserve Bank of India Amendment Directions 2026, NUCFDC has been permitted to make a private placement offer of equity shares to more than how many persons in aggregate in a financial year? So basically, there is a limit on private placement offer. Private placement offer means that to a selected group of investors, the offer of the shares are sold to a selected group of investors, or the securities are sold to a selected group of investors only. So there is a limit of 200 persons in a financial year for the private placement offer. For the NUCFDC, this limit has been removed because this is the entity which needs to include the urban cooperative banks, which need to provide the shareholding to all the urban cooperative banks. So 200 persons. Okay. So NUCFDC, it is National Urban Cooperative Finance Development Corporation Limited, has been set up as the umbrella organization for the primary urban cooperative banks. There are 1400 plus primary urban cooperative banks, and the NUCFDC has to include these urban cooperative banks as the shareholders. So the 200 person limit has been removed for the private placement offer for the NUCFDC till what timeline? Till March 31st, 2029. Okay. Now coming to the March. Now we are starting with March articles. Okay. So Jan and Feb, the most important articles I have tried to discuss with you through the MCQ format, or I have tried to bring the MCQs for you. Now we are going to start with the MCQs from March onwards. Okay. Chalo. Now try to answer the questions. India and Japan renewed their bilateral swap arrangement. Under the renewed arrangement, the maximum swap size retained is. What is the answer? $75 billion. Very good, everyone. That is absolutely correct. India and Japan renewed their bilateral swap arrangement. Under the renewed arrangement, the maximum swap size retained is $75 billion. Next question is that under the Reserve Bank of India's NBFC prudential norms on capital adequacy, Second Amendment Directions 2026, the eligible quarterly profit of the current financial year can be included in free reserves after reducing it by a fraction of the average dividend. Basically, the idea is that the eligible profit that can be added in the owned funds, or that can be added in the free reserves or something. So eligible profit is net profit minus 3 years, the minus 0.25, that is 25% basically of the dividend, average dividend in the past 3 years, average dividend per year in the past 3 years, so last 3 years. Okay, this we have discussed again and again. So this is the idea, this is the formula that is used, that is the eligible profit is taken at the eligible profit that can be added in the own fund, or that can be added in the free reserves. So eligible profit that can be added in the free reserves, okay, that can be added in the own fund or such. So in this case, eligible profit is your net profit minus 0.25 multiplied by the average dividend in the past 3 years. Okay. Chalo. The rest you can read once, and the important points have been provided here, that the Reserve Bank of India requires NBFCs to maintain a minimum level of capital called owned fund to absorb potential loss and safeguard depositors and investors. Now it has been said that the profit can be included in the free reserves or the owned fund on the quarterly basis also, following this formula, that the eligible profit to be added in the free reserves will be the net profit in the quarter minus 0.25 multiplied by the average dividend of in the past 3 years. Okay. So average dividend paid in the last 3 years. Chalo. Next is ROU, that is right of use. If there is some property, if there is some asset that you have, that the NBFC has the right of use. So right of use asset arising from leasing a tangible physical asset shall not be deducted from own funds in the case of mortgage guarantee companies, core investment companies, and the housing finance companies. Now for the standalone primary dealers, they can also add the eligible profit in their tier 1 capital. Okay. uh, if that is coming from the quarterly basis. Chalo. Now coming to the next question. As per the RBI's prudential norms on declaration of dividend directions 2026, so these directions were released in March 2026, State Bank of India is not permitted to distribute dividends beyond what percent of its reported profit after tax, irrespective of its bucket eligibility. So basically, the commercial banks, including the State Bank of India, they can release the dividend on the basis of the adjusted profit after tax. But it should not be exceeding 75%. It should not be exceeding 75% of its reported profit after tax. Okay. 75% of its reported profit after tax. So 75% is the answer and D is the answer here. Chalo, this is the idea. So basically, the dividend allowed as a percentage of the adjusted profit after tax. So how much dividend can be paid out? How much dividend can be paid out? It depends upon the adjusted profit after tax, but it should not be more than 75% of the reported profit after tax. So dividend uh, that is allowed as a percentage of adjusted profit after tax, it can be 80%, 90%, 100% also, but it should not exceed 75% of the reported profit after tax. Okay. Now coming to the next question, that is, as per the RBI commercial banks prudential norms, which ratio is used as the key input to determine the permissible dividend payout by banks incorporated in India? In the table before, you must have seen that the dividend that can be paid as a percentage of adjusted profit after tax, which is under the 75% limit of the profit after tax. Now, how much dividend is paid out? It depends upon how much common equity tier 1 capital the commercial banks have. If the commercial banks have good common equity tier 1 capital, sufficient common equity tier 1 capital, if the banks are fulfilling the minimum regulatory requirements, then the banks can give the dividend as per the bucket list. Okay. So, the commercial banks, on the basis of common equity tier 1 capital, they can determine the dividend payout. So C is the answer here, common equity tier 1 capital. So that we saw in the table, that common equity tier 1 ratio, on the basis of how much common equity tier 1 ratio the bank has, the bank can do the dividend payouts. Okay. Now coming to the next question, try to answer this question. So now, as per the RBI's prudential norms on declaration of dividend directions 2026, which of the following statements is or are correct? RRBs, local area banks, are not permitted to distribute dividends beyond 80% of their reported profit after tax, irrespective of their budget bucket eligibility. Absolutely correct. Adjusted profit after tax is calculated by reducing the reported profit after tax by 50% of the net non-performing asset. So adjusted profit after tax is profit after tax. Adjusted profit after tax is the reported profit after tax minus 50% of the net NPA, net non-performing asset. Okay. Common equity tier 1 ratio is used as the key input to determine the permissible dividend payout for the small finance bank and the payment bank. For the small finance bank and the payment bank, tier 1 ratio, not common equity tier 1 ratio. It is tier 1 ratio that is the key input to determine the dividend payout. So first is correct, third and second are incorrect. And that's why the right answer here is 1 only. Any confusion? So D is the right answer. Basically, you can see that for the small finance bank and payment bank, the tier 1 capital ratios are used. For the local area bank, CRAR is used. For the RRBs, also tier 1 capital ratio is used. Only for the commercial banks and the State Bank of India, the common equity tier 1 capital requirement is used. Okay. Now, for the commercial banks and State Bank of India, basically 75% of the profit after tax is the maximum dividend payout that can happen. For the small finance bank and payment bank, same is true. But for the local area banks and for the RRBs, 80% of the reported profit after tax can be the dividend payout. This is the idea. Okay. So remember that for the local area banks and RRBs, 80% of the reported profit after tax. So basically, RRBs and the local area banks, they are not permitted to distribute dividend beyond 80% of their reported profit after tax. Absolutely correct. Adjusted profit after tax, here we have to deduct 50% of the net non-performing asset. Common equity tier 1 capital, like common equity tier 1 capital is the key input for deciding the dividend payout for commercial bank. Tier 1 capital, it is the key input for deciding the dividend payout for small finance bank and payment bank. So common equity tier 1 capital is used as the key input for deciding permissible dividend payout for the small finance bank and payment bank. No, it is the tier 1 capital, not the common equity tier 1 capital. Got it now? Is it clear? Chalo. So it is the tier 1 capital, not common equity tier 1 capital. So for commercial banks, it is common equity tier 1 capital. But for the small finance bank, payment bank and RRBs, it is tier 1 capital. Moving forward, to the next question, try to answer this question, that when it comes to CMIs, so Reserve Bank of India under the prudential norms on capital adequacy has prescribed different add-on factors for the market related off balance sheet contracts. Okay, so there is add-on factor that basically shows that how much the risk is involved for the future, the what can be the potential risk for the future. So these are the add-on factors. Which of the following statements is or are correct in this regards? For payment banks, only the exposures on, see, market related off balance sheet contracts, here we are talking about derivatives. Now, derivatives can be interest rate derivatives, equity derivatives, exchange rate contracts, and gold and such. So, for payment banks, only the exposure, the add on factor is on the exchange rate contracts and gold. They are relevant for the add on factors. Absolutely correct. For the payment banks, only the exposure on the exchange rate contract and gold are relevant for add on factor. Correct. For interest rate contracts with total maturity over 1 year, more than 1 year, the add on factor cannot be less than what? Even if their periodic reset reduces the exposure. So periodic reset is happening maybe after 3 months, maybe after 6 months. If the contract is of 10 years, the periodic reset is happening 3 years, maybe after 3 months, 6 months, maybe after 9 months, maybe after 12 months, the periodic reset is happening. So the for interest rate contract with total maturity of over 1 year, the add-on factor cannot be less than 0.50%. This is very, very important. If a bank is a clearing member of a QCCP, that is qualified central counterparty is involved, where the central counterparty, qualified central counterparty has the responsibility to clear the transactions, okay, between the clients, between X and Y. Now, the bank can treat this exposure to the QCCP as low risk and with a 2% risk weight while calculating the capital. So, this is also correct that if the QCCP is involved, then the risk weight can be 2%, can be low at 2%. So, first statement is correct, third statement is correct, second is wrong. And that's why the right answer is, what is the right answer here? I want all of you tell me that A, B, C, D, E. What is the right answer here? Very good. Very good. E is the right answer here. Vaishali, very good. Abhyudaya, very good. So E is the right answer here. Okay? That is only E2 was incorrect. So basically, if there are the derivatives that a bank is purchasing, if a regulated entity is investing, if the commercial bank, small finance bank, payment bank, all India financial institutions, if they basically are investing in the derivatives, it can have the future exposure. It can have the exposure. Okay. So here we take the credit exposure for current credit exposure, how much exposure you have right now, and the potential future exposure. For future exposure, there is the add-on factor that is taken. Now, add-on factor is provided for interest rate contracts, exchange rate contracts, equities, precious metals, except gold. But for the payment banks, only the exposure on the exchange rate contracts and gold are relevant for the add-on factor. The next important thing is that when the QCCP are involved, see, if the periodic reset is happening, then if the periodic reset is happening, then if let's say the contract is of 10 years or more than 10 years, okay, so over 5 years, so if the contract is for a longer duration, then the higher add-on factor should be applied, but there is the periodic reset every 3 months or every 12 months. Okay, so 1 year or less, the periodic reset is year or less, or over 1 year to 5 years. So according to that, the add-on factors will be applied. But in the case of interest rate contracts with total maturity over 1 year, the add-on factor should compulsorily be not less than 0.50%. And if the QCCP is involved, then 2% is the risk rate. Now, coming to the next question, read the question that under the Foreign Exchange Management Export and Import of the Currency Amendment Regulations, submission of the currency declaration form is exempted. So, submission of the currency declaration form. Let's say a traveler is coming into our country, they have to fill the currency declaration form, that how much currency they have brought. So, this currency declaration form they will not have to fill if when the value of foreign currency notes brought into India does not exceed how much? It does not exceed 15,000, 7,500, 20,000, 10,000, or 5,000. It does not. Value of foreign currency notes. Here, particularly, notes have been mentioned. That means we are not talking about the other instruments, the traveler's check or something. We are only talking about notes. Be careful when you are answering these kind of questions. 5,000. 5,000 is the answer here. Okay. So basically, the currency declaration form is not required from the foreigners or from the travelers. This is not required to be filled if the total foreign exchange brought in the form of notes, in the form of traveler's check, in the form of any other instrument, if it does not exceed $10,000. But in the case of foreign currency notes, it should not exceed $5,000. Got it? Sorry. Next question is that Reserve Bank of India observed the sixth edition of the Digital Payment Awareness Week. Since which year has RBI been observing Digital Payment Awareness Week annually in the second week of March? In the second week of March. Since when? So RBI has observed the sixth edition of the Digital Payment Awareness Week. Since which year has RBI been observing Digital Payment Awareness Week? Since 2021. Very good, everyone. Very good. Since 2021. This is the idea here. Now, coming to the next question, a very easy question. I hope most of you will be able to answer this question. With reference to RBI, Unique Identifiers and Financial Market Directions 2026, LEI, that is Legal Entity Identifier, that identifies the legal entities, that identifies the companies that are part of the financial transaction, is a unique dash character alphanumeric code assigned to legal entities participating in financial transaction. So what is the character? What is the character in the LEI? In the LEI, there are 20 characters. Very good. In the UTI, that is the unique transaction identifier, what are the number of characters? In the UTI, what are the number of characters? There are, anyone? 52 characters. And the starting 20 characters are of the LEI. Okay? So this is the idea. So here LEI has 20 characters while the UTI has 52 characters. LEI identifies the entities which are engaging in the financial transaction while the UTI is for the OTC derivative transactions only. Okay. UTI, which entities are involved in the development of the UTI technical code? Which entities are involved in the development of the UTI technical code? Which entities? CPMI of BIS and IOSCO. Remember these, okay? Chalo. Now coming to the next question. Reserve Bank of India, while prescribing prudential limits for authorized dealer banks in the domestic foreign exchange market, has fixed the maximum permissible net open position in INR at the end of the day at what? So basically, if you are an authorized dealer, you are buying 1,000 million dollars while you are selling 700 million dollars. That means you have 300 million dollars left. So instead of keeping it with you, you have to supply it in the market before the end of the day. You have to supply it in the market, and you can only keep up to 100 million dollars with yourself. Okay. So if you are buying the dollars, if you are selling the dollars, then at the end of the day, you shall not have the net open position of more than USD 100 million, or at the end of the day your net open position can be maximum up to 100 million dollars only. So B is the answer here. That is all. Now coming to the next question. As per the latest decision of the Reserve Bank of India, the sanctioned ways and means advances limit for the Government of India for the first half of financial year 2026-27, April to September 2026, has been fixed at what? So ways and means advances, it can be maximum for 90 days, and the interest rate here is repo rate. If the overdraft is there, then the interest rate is repo rate plus 2% for the overdraft. Now, what is the limit that has been decided for the April to September 2026? That is for the first half, 2.5 lakh crore. And if dash percentage of the WMA limit has been used, then the Reserve Bank of India initiates the fresh flotation of the of the securities for the government. What percentage? If dash percentage of WMA limit has been utilized by the government, then the RBI issues the fresh flotation. 75%. Very good. Very good. Good to see this. So if 75%, yes, of the WMA limit is utilized, then the fresh market borrowing happens, is initiated by the RBI for the Government of India. WMA limit is 2,50,000 for the first half of financial year. Now coming to the next question, try to answer this question. Not a difficult question. Try to answer this. As per the recent trade relief measures for exporters, RBI has advised extension of the in the time period. extension in the time period for realization and repatriation of the full export value of goods and software service exported from India from 9 months to how many months? So basically, repatriation, realization, the exporters, they have to realize the value and they have to repatriate it back to India. Before they had to do it within 9 months. Now 15-month timeline is provided, as well as regulated entity may permit an enhanced credit period. So regulated entity may permit the enhanced credit period of 470 days or pre-shipment and post-shipment export credit to get dispersed till June 30th, 2026. So C is the answer here. Very good. So basically, trade relief measures for exporters, this was introduced or this was extension was provided in 2026. Okay, there is a slight mistake. It is 450 days. My bad. Not 470. Sorry, I will correct this. Okay, I will correct this. Yes, it is 450 days, not for 470. Sorry. So question number 36, I will make the correction. And see, the PDF will be provided to you. Question number. The PDF will be provided to you in the Telegram channel. In the Telegram channel of EduTap, you will get the PDF of the session by 10 p.m. I think you will get the PDF. Okay. And tomorrow you will get the updated PDF. So tomorrow morning you will get the updated PDF. Okay. So today 10 p.m. you will get this PDF where you might see these kind of silly mistakes by me. So I will correct it, and tomorrow you will get the updated PDF by 12 p.m. But today 10 p.m. you will get this PDF. By tomorrow you will get the updated PDF with the corrections. Chalo. Now here basically the RBI had extended RBI had provided the extension in the time period for realization and repatriation of full export value from India from 9 months to 15 months. This expansion was provided, as well as for the credit period, this was extended to 450 days. Okay, this is the idea. Now, applicability is that these commercial banks, primary urban cooperative banks, state cooperative banks, central cooperative banks, NBFC factors, all India financial institutions, if they are providing the credit, the extended time period of 450 days can be provided for loans till June 30, 2026. That is the idea. Chalo. Now, coming to the next one. Vashri, are you a part of the course? And Shruti, Priyanka? Like the course students, they will get it. Okay. But in the course, I think. Chalo. Under the RBI. So in the Telegram channel of EduTap, you will get the PDF at 10 p.m. today, so that you are able to revise, you are able to go through the document again. But tomorrow by 12 p.m. you will get the updated PDF. So if you want to see the updates that that I have told you, like 450 days and such, so that you can get by tomorrow. So download the updated PDF tomorrow. Under RBI's directions and overseas investment, RBI direction on overseas investment, RBI has now shifted to a decentralized system wherein overseas investment references. So basically, let's say that you want to do the more investment in the other countries. In Vietnam, you want to invest more. So if you want to invest more, then you have to take the approval from the Reserve Bank of India, because you want to invest higher than the allowed or up automated like automatic route. So through higher than that you want to invest, so for that you have to send the request to the authorized dealer category 1 banks, and they will forward your request to how many regional or to the regional offices. Now how many regional offices are decided for such kind of references, request, or such kind of things? 7 regional offices are designated. Okay, and the authorized dealer category 1 can send to any of the regional office that is designated to this authorized dealer or to that area. So earlier, if the Indian person or company wanted to invest more money abroad through the approval route by taking the approval of the Reserve Bank of India, they had to request it through the authorized dealer bank. And this request was going to the Foreign Exchange Department of the Central Office of the RBI. Now 7 regional offices have been designated to be able to handle these kind of requests. Coming to the next question, that with reference to FPI investment limits for financial year 2026-27, what is the investment limit for the corporate bonds and total notional value of the credit default swap sold by all FPIs together shall not exceed what percentage of the total outstanding stock of corporate bond in India. So basically, investment limit for the corporate bond is like for the state government securities, the investment limit is for the central government securities. Limit is investment limit for the FPI is for the corporate bond, the investment limit is so for the state government securities, the investment limit is 2%. For the central government securities, the investment limit is 6%. For the corporate bonds, the investment limit is 15%. And for the credit default swap, there is the limit of 5%. So here the right answer is C. Very good. So these are the investment limits for the foreign portfolio investors as well as for the credit default swap sold by all FPIs. The limit is not exceeding 5%. So the limit is 5%. Under the master action on facility for exchange of notes and coins, up to how many soiled notes can be exchanged immediately at the bank counter. So if we are talking about the soiled notes, how many soiled notes can be exchanged immediately at the bank counter free of charge subject to the prescribed value limit of 5,000. So 20 notes. That is the answer. But in the case of mutilated notes, now in the case of mutilated notes, how many notes can be exchanged immediately at the bank counter? In the case of mutilated notes, this answer, in the case of mutilated notes, 10 notes. Okay. Chalo. So no bank branch can refuse to accept coins of denomination 50 paise, 1, 2, 5, 10, 20 rupees uh, at its counter. The coins of 25 paise and below have ceased to be legal tender. Remember this. Now, soiled notes up to 20 notes subject to the maximum value of 5,000 rupees per day shall be exchanged by the bank immediately at the counter free of charge. If the number of notes goes beyond 20 or the total value goes above 5,000 in a day, then the value has to be credited to the person within the maximum period of 7 days. Up to 10 notes, that is mutilated, and the imperfect notes up to 10 notes shall be exchanged by the bank immediately at the counter. If the notes goes beyond 10 notes or total value goes above 5,000 rupees in a day, then the money can be transferred maximum period of 30 days. Now coming to the next question, try to answer this. With reference to the master action on incentives for currency distribution and exchange and penalties, again and again we have discussed this, again and again I have focused on this, that there are the scheme of penalties, there is the scheme of incentive. If the banks they are providing the services in an efficient manner, they will get the incentive. If there are the deficiency in service, they will have the penalties. Okay, so now bank can get up to 100% reimbursement of the capital cost subject to a maximum of what amount for opening of and maintaining currency chest in northeastern region and at the inaccessible or hilly places of Jammu and Kashmir and Ladakh union territories. So bank can get up to 100% of reimbursement of the capital cost subject to maximum of 50 lakh. This is the answer. Chalo, let's continue now. So this we have discussed again and again. You have to go through the whole chart. Okay. So remember that the incentives are very important. The penalties are also important. So capital cost. Now, in the case of revenue cost, how much of the revenue cost is covered for the maintenance of the currency chest? How much of the revenue cost is covered and for how many years this revenue cost is covered? So the revenue cost of 50% will be covered and the revenue expenditure of 50% will be covered for the period of 5 years. In the case of distribution of coins, if the coins are distributed in the suburban or rural areas, in this case, in the case of distribution of coins, what is the extra incentive that you get? I'm just asking about the additional incentive, the additional incentive that you get. So in the distribution of coins, for that you get 65 rupees as the incentive. But if you are distributing the coins in the suburban or rural areas, you get the incentive of additional 10 rupees. That is, in total you get the incentive of 65 plus 10 for distributing in rural and urban area. Okay. Now coming to the next question, this was released in June 2026. Okay, though we are right now doing the March articles, but let's just discuss this also, that the RBI has recognized which of the following entities as the SRO for the account aggregator ecosystem. So I think yesterday only this article was released, that the RBI has recognized which of the following entities as the SRO for the account aggregator ecosystem. So Sahimati Foundation, it has been recognized as the SRO for the account aggregator ecosystem. Okay, so Yes, 5th June 2026, this article was released that the Sehmati Foundation has received the approval from the Reserve Bank. So, application seeking recognition as an SRO account aggregator by the RBI was received from Sehmati Foundation. Now, based on the examination, it has been decided to recognize Sehmati Foundation as an SRO for account aggregator ecosystem. Now, for the account aggregator ecosystem, the same rule applies for all the SROs that they should be registered under Section 8 of the Companies Act 2013. That means they should be a not-for-profit company and they should be sufficiently diversified. No entity shall hold 10% or more of its paid-up share capital. Okay? The applicant should have or demonstrate to achieve a minimum net worth of rupees 2 crore within a period of 1 year after recognition as an SRO account aggregator. So, minimum net worth requirement is of 2 crores within a period of 1 year after recognition as an SRO. Now, coming to the next article, SRO is the self regulatory organization. They are the organization that help the Reserve Bank of India to connect with the regulated entities. So, the SRO, like for the NBFC domain, there is the SRO. For the fintech domain, there is the SRO. For the account aggregators, for the authorized dealers, there are the different, like for the fintech section also, there is the SRO. I think for fintech, face is there. So, there are SROs that work as the connecting point for the RBI and the regulated entities so that the regulated entities in the case of NBFC account aggregators they can share the concerns with the SRO which can share it with RBI. Okay, chalo try to answer this now. SRO is self regulatory organization. Yes, correct. Which of the following statements is or are correct with reference to the RBI's operational guidelines of floating rate saving bond 2020? So, which of the following statements is or are correct with reference to the RBI's operational guidelines of the FRSP? So, brokerage is, see, the floating rate saving bond for that operational guidelines have been released in 2026. The brokerage, like for the FRSP, there is a receiving office that provides to the investors the floating rate saving bond. So let's say you want to purchase the floating rate saving bond. So there are receiving offices. Okay. So they get a brokerage of 50 paise per 100 rupee of subscription amount that is mobilized by them from the floating rate saving bond. So the floating rate saving bond, this is the bond of the government of India through which the government of India is raising funds and the receiving offices they sell it to the investors. Now whatever money has been collected by the receiving office that has to be sent to the government of India, for that they get a brokerage of 50 paise per 100 rupees. Okay, the coupon rate is linked. Now for these kind of floating rate saving bond which is the government of India bond, the the interest rate is periodically changing and the coupon rate, that is the interest rate on these bonds, it is linked to the national savings certificate rate with an additional spread of 0.35%, with an additional spread of 0.35%. Lock-in period for investors age 80 and above shall be how many years? 4 years. 4 years. So second statement is wrong, third statement is also wrong, only the first statement is correct, and here the answer should be what to repeat, Sapnadeep? Have you not studied the floating rate saving bond? It is a very important article that you have to study. Okay, so basically let I will be repeating it when I will explain it again or when we discuss the explanation. So second and third statements are wrong and that's why the right answer here is 2 and 3 because incorrect statements you had to identify. So B is the right answer. Okay, so basically investment structure, the floating rate saving bond, they are the bonds, they are the debt instruments of the government of India in which you have to invest the minimum amount of what, in which you have to invest the minimum amount of 1,000 rupees. Okay, so if you want to invest, you have to invest, the minimum investment is 1,000 rupees and in the multiples of 1,000 the interest on this floating rate saving bond depends upon the national savings certificate with the added spread of 0.35%. So whatever is the national savings certificate rate plus 0.35%, that is the rate for the floating rate saving bond. Interest rate every 6 months it get reset. Now premature encashment, so basically the floating rate saving bond, it has a lock in period of 7 years. But let's say you are the individual aged 60 years or above. So for that 60 to 70 years, the lock-in period is 6 years. 70 to 80, lock-in period is 5 years. 80 and above, the lock-in period is 4 years. So the lock-in period is not 5 years, it is 4 years for 80 and above. That is the idea. Okay. Now the brokerage, so service charges, receiving offices that are providing the investors with the excess of floating rate saving bond, they are paid. So if receiving offices, they are paid 25 rupees for opening new bond ledger account for the new investor in the floating rate saving bond, and for maintaining the existing accounts, for servicing the existing accounts, 20 rupee is the charges, maintenance charges. Okay. Brokerage is 50 paise is paid on each 100 rupee mobilized, that is 0.5%. Chalo. Moving forward with the question, the Reserve Bank of India has introduced a new pilot framework from financial year 2026-27 to improve the liquidity and price discovery in the state government securities market. Under this framework, participating states will issue securities only in a predefined standard maturities. Otherwise, they were releasing in different maturities. That was very confusing for the investors. Now, which of the following initiative is being referred to in the above paragraph? So, which of the following initiatives? State debt rationalization framework, state securities market? No. It is benchmark issuance strategy. So, Reserve Bank of India has launched the benchmark issuance strategy, where the RBI has said that the state government securities will be released in the fixed tenures, and in the initial phase, 9 states are brought under the benchmark issuance strategy. Okay. Chalo. Next is, read this question and try to answer. Under the phased implementation schedule prescribed by the RBI for reporting OTC, over the counter foreign exchange derivative contracts involving INR by authorized dealer category 1 banks for their related parties, an authorized dealer category 1 bank shall have the option to not report certain small transactions if their size is up to what? So basically, if the authorized dealer category 1 banks, if their related parties are undertaking some kind are undertaking the OTC forex derivative contracts involving the INR. So in this case, authorized dealer category 1 have to report to the trade repository of the CCIL. But it has been said that the authorized dealer category 1 bank shall have the option to not report certain small transactions if their size is USD 1 million or is up to USD 1 million. Okay, E is the answer here. So basically, transactions exempted from reporting. So authorized dealer category 1 bank shall have the option to not report certain transactions. So transactions exempted from reporting are back-to-back transactions or the overseas related party transaction which is happening with the other authorized dealer category 1 bank, with another authorized dealer category 1 bank. And authorized dealer category 1 bank shall have the option to not report certain small transactions if their value is up to $1 million. Now, for the parents, for let's say the authorized dealer category 1 bank related to its parent or the or the branches of the parent, for that, by from 1st July 2027, 100% of reporting should happen. 100% of reporting should happen for the parent and its branches. For the other related parties which are not the parent, then there is the phase manner the reporting should happen. Chalo. Coming to the next question, try to answer this question. With reference to the Reserve Bank of India undertaking of financial services directions governing investment in alternative investment funds, which of the following statements is incorrect? So basically, according to the alternative investment fund directions, or according to the limits on the regulated entities regarding their investment in the AIF's alternative investment fund. So alternative investment fund is a privately pooled fund which collects the money from the sophisticated investors, and the money is invested in the different securities. Now the regulated entities, they have certain limit of their investment in the AIF. So a regulated entity cannot individually contribute more than 10% of the corpus of a category 1 or category 2 AIF. Absolutely correct. The aggregate contribution should not be more than 20%. If a regulated entity holds more than 5% in an AIF, and the AIF subsequently invests in a company that is already a borrower of the same regulated entity, in this case, the provisions have to be maintained at 100%, not 50%. So, C is incorrect. Investment made by regulated entities in subordinated units of an AIF are required to be fully deducted from their capital. So basically, if the regulated entity is investing in the subordinated units, that are the units which get the profits in at last, or which get if the loss happens, they have to handle the losses basically. So these are the subordinate units, so they are fully deducted from their capital. Absolutely correct. Agrisure, a category 2 AIF registered with SEBI, has been exempted from the RBI norms governing investment in AIF. So this is also correct. So only the C statement was wrong, the rest are correct. So that's why C is the answer here. Okay. So these are the limits on the regulated entities, their investment in the alternative investment fund. Basically, Agrisure has been exempted from these regulations. Swahamiya Investment Fund 1, it was previously exempted from these norms. Now, RBI under its Payment Vision 2025 aims to make cross-border payments cheaper, faster, more transparent, accessible in line with the G20 roadmap. The RBI Payment Vision 2025 is built around which of the following pillars? So Payment Vision 2025, it is quite in news, as well as in annual report also there are the five pillars that were mentioned of the Payment Vision 2025. So try to answer this question. Try to think about it, try to answer it. Anyone? A is the answer here. Integrity, inclusion, innovation, institutionalization, and internationalization. So A is the answer here. Okay. Chalo. Why this question I have asked? Because in the annual report, this was given that during the year DPSS, that is Department of Payment and Settlement System, undertook several initiatives in line with Payment Vision 2025 across the pillars of integrity, inclusion, innovation, institutionalization, and internationalization. Now, the RBI under its, as well as in March, this article was also released that RBI under its Payment Vision 2025 aims to make cross-border payments cheaper, faster, more transparent, accessible. So basically, the guidelines were released in this regards for the cross-border inward transactions to immediately have the inward message to the customers and such, and for nostro statements, that is if the Indian bank account that is held with the foreign banks, if they are getting, so Indian bank's account, if it is held with the foreign bank, if it is receiving the foreign currency, so immediately like on the hourly basis, at least like before that also, or not exceeding 1 hour. So on the, like before 1 hour, or like at least not exceeding 1 hour, there should be checking that should happen of the accounts. Okay, that how much of the receipts have happened, how much of the internal remittances have been received and such. Answer is A, because it is integrity, inclusion, innovation, institutionalization and internationalization, interoperability, no, infrastructure, no, no, no. Okay, interoperability is not mentioned now. It is inclusion, integrity, innovation, institutionalization and internationalization. Chalo. So if the internal remittances are coming, if the inward transactions are happening, if we are receiving the see, if the people of our country, if the people of our country, they are receiving the remittances from the other countries, so in this case there should be faster cross border remittances that we should be able to receive, and the problem is at the beneficiary account level. So the immediately the message has to be sent to the customer or to the client or to the beneficiary basically, that there is the money that is being received from such and such country, from such and such person. Okay, so this is the idea. And the nostro account, so Indian banks, they maintain a account with the foreign banks, that is the nostro account, where they can receive the foreign currency remittances, and they can receive the foreign currency. So Indian bank has to check this nostro account or nostro statements on the real time basis, but at least if not real time, then not exceeding 1 hour. Okay, next, try to answer this question. What to remember? This integrity, innovation, like think about it now, that if RBI is talking about, it will talk about integrity. That is always the first thing that RBI thinks about. Then innovation, that is where the focus is on the payment vision, digital payments, innovation, institutionalization. So the institutional capability has to be developed. The cross border payment, the RBI is focusing on that. So internationalization and inclusion. So payments, so inclusion. Okay, sorry. Now, under the digital payment e-mandate framework, uh, for that you need to have the additional factor authentication. Okay, you need to have for the e-mandate, you need to have the additional factor authentication. Recurring payment transactions can generally be executed without additional factor of authentication up to how much per transaction? 15,000 per transaction. For the insurance payments, for the card payments, for such kind of payments, what is the amount for the transaction without addition factor authentication? It is 1 lakh. Okay, so here 15,000 for the general transaction, 15,000. So this is the idea that for these kind of transaction, like for all recurring transaction may be authorized without addition factor authentication if up to 15,000 per transaction. But transactions above this need to be addition like have the addition factor authentication. Payment of insurance premium, subscription to mutual funds and credit card bill payments may be made without addition factor authentication up to 1 lakh rupees. Now, which like pre-transaction notification has to be sent before deducting the amount under the e-mandate? Pre-transaction notification should be sent 24 hours before the transaction happens. Now, for which particular instruments this pre-transaction notification is not allowed? Additional factor authentication for the e-mandate, for the electronic mandate. If you want to do the recurring transaction, you need to have the additional factor authentication. You need to provide OTP or some additional factor authentication. Authentication has to happen for the recurring transaction. Now, additional factor authentication is not required for the transactions up to 15,000, the regular transactions. And the transactions like the insurance payments or the card payments, for these kind of big transaction, the transaction up to 1 lakh, for this the addition factor authentication is not required. Pre-transaction notification, whenever the money will be debited, before that 24 hours before that you will get the notification, but this kind of notification is not required. Pre-transaction notification is not required for the fast tag auto replenishment and the NCMC balances. Okay, now, RBI has released the results for the Harbinger 2025 that was launched with the theme of secure banking, powered by identity, integrity, and inclusivity. So, RBI is focusing on integrity, inclusivity, and identity under the Harbinger 2025. That is hackathon innovation. Innovation is focused here. Now, which of the following solutions enables offline CBDC E2P transactions using proximity based technologies like Bluetooth and near field communication? So, which of the following solutions? So, basically, results have been released for the Harbinger 2025. There were three problem statements under this Harbinger 2025, and under this, a solution has been developed enabling offline CBDC E2P transactions using proximity based technologies like Bluetooth and NFC. So, a Spursh. Think about it that when we are talking about near field communication, we are talking about offline CBDC. So, Spursh. Okay, this is the answer. C is the answer here. So the results have been released. So for there are three problem statements. Tokenized KYC. There is tokenized KYC. This is one of the problem statement. Another is offline CBDC, and another problem statement was enhancing trust. Okay, so in the offline CBDC, Spursh is the winner, and this product is the winner, and this product is basically, or this facility is basically, it works through nearby technologies like Bluetooth, near field communication, and such. So basically under this Harbinger innovation, the global hackathon Harbinger, this has been operating since 2021, and here Harbinger 2025 has run into three phases. There were uh, three problem statements that were provided. The theme of the Harbinger was secure banking powered by identity, integrity, and inclusivity. There were three problem statements that were provided: tokenized KYC, offline CBDC, enhancing trust. Under this, the winners have been chosen, and for tokenized KYC, it is Earth ID, and the runner-up is Baldor. Earth ID has developed Sangre, Baldor has developed Kavach. Offline CBDC, Team Aspursh is the winner that has developed Aspursh, and the runner-up is Bank of Baroda Innovation Hub that has developed Bharat Ready Inclusive CBDC. Okay. Enhancing trust, it does not have any winner, it only has a runner-up, that is Team Fraud Lens for the fraud lens. Best all women team is Nidan. Bank of Baroda Innovation Hub, Team Nidan. No, it is not important as such. Okay, 15 countries have participated. The names you don't have to remember. The names are not important. Anyway, you will not be able to remember all of the names with all the other data that you have to remember. Under the RBI branch expansion framework for deposit taking NBFCs, entities having net owned fund up to what are restricted to operating within the state of registration. So, for the NBFC, this particular direction was released that under the RBI branch expansion framework for the deposit taking NBFCs, they will be restricted in their state only if they have net owned fund up to 50 crores. Okay, as well as Shivraj, you can download it through the Telegram. In the course it will be provided. You have to like mail at the you have to mail to the team. Okay, I am not aware about it. See, 50 crore. So net owned fund, see, condition of deposit taking NBFC, where can it open the branches or appoint agents? So basically, if the net owned fund is up to 50 crore or the credit rating is below A, then only within the state where its registered office is located, it can open the branches or appoint the agents. Net owned fund is more than 50 crore plus the credit rating is A or above anywhere in India, it can open its branches or appoint agents. The NBFCs, they are not allowed to open their branches outside India, but if let's say they already had branches outside India, then then and they have taken permission from RBI, but now they cannot open any new branch. Okay, this is the idea. Next is this question. Try to answer this. This is from the half yearly report. So, as per the half yearly report on management of foreign exchange reserves, these are the statements. Which of the following statements is or are incorrect that you have to tell? Okay, so which of the following statements is or are incorrect? Amount lent under SHARK and Asia Clearing Union currency swap arrangements are excluded while calculating foreign currency asset. Absolutely correct. Because this money has been lent out, so it will not be included in the foreign currency asset. As at the end of March 2026, RBI held 880.52 metric tons of gold. Why this is very important? Because in June 2025, RBI has given the clarification that this is the amount of gold that we are holding, and whatever fake news that is going on in the YouTube or the social media space, that is fake, that is not true. We have not sold the gold. This is the tons of gold that we are holding. So this is again in news, that's why it becomes important. RBI has the mandate to invest up to $1 billion dollars in the bonds issued by the India Infrastructure Finance Company Limited. Is it so? Under the revised shark currency swap framework, RBI has signed bilateral currency swap arrangement with the Royal Monetary Authority of Bhutan and Bank of Mauritius. So, third statement is wrong, right? The fourth statement is also wrong because the RBI has a mandate to invest up to $5 billion dollars in the bonds issued by the India Infrastructure Finance Company Limited. As well as under the revised Sharks currency swap framework, RBI has signed the bilateral currency swap arrangement with the Royal Monetary Authority of Bhutan and Maldives Monetary Authority. So, third and fourth statements both are wrong, and that's why D is the answer. Bhutan and Maldives here. Okay. So foreign currency asset, so the following are excluded from the foreign currency asset: investment in bond issued by IIFC, SDR holdings, amount lent out, the RBI's contribution to funding of Nexus Global Payments. As at the end of March 2026, RBI held 880.52 metric tons of gold. There is also the clarification that the RBI has given recently in June 2026 that the latest edition is available on the RBI website. The physical stock of gold remains unchanged at 880.52 tons of gold. Now, next is that foreign currency asset, where is it invested? If the RBI is keeping dollars or euro, it is actually invested in securities, deposits with other central banks and Bank of International Settlement, or deposit with commercial banks overseas, so that the RBI can keep on receiving the interest rate. Okay. Next is shark swap arrangement. Under this, the Maldives Monetary Authority and Royal Monetary Authority of Bhutan, they have taken the facility under the shark currency swap framework. This is the idea. IIFC. So investment in bonds, RBI has the mandate to invest up to $5 billion dollars in the bonds issued by the India Infrastructure Finance Company Limited. Now coming to the next question. Okay, so under the RBI's master action on counterfeit notes detection, reporting, and monitoring, what action is required when counterfeit notes are detected in a single transaction? So read the statements and try to answer this. Sorry for this. Just zoom in your mobile phone a little to show you the whole question. I will have to keep it like this. Okay. Chalo. So now, if up to three counterfeit notes are detected and the matter is immediately reported to the police, if five or more are detected, it is reported to RBI. No. In the case of counterfeit notes, if four notes are detected, the matter is reported to local authorities at the end of the month. If six or more are detected, then it is immediately reported to police. No. If five are detected, no police report. No. If up to four counterfeit notes are detected, the matter is reported to local authorities at the end of the month. And if five or more are detected, it is immediately reported. This is correct. If four counterfeit notes are detected, the matter is reported at the end of the month. But if more than five or more than five, it is immediately reported to the police. So this is the idea. Chalo, D is the right answer here. Okay. So basically, if up to four counterfeit notes are found in a single transaction, the nodal office, bank office, shall report it to the local police authorities at the end of the month. If five or more counterfeit notes are detected in a single transaction, the nodal bank office must immediately report it to the police. Now, the information has to be provided by the first note vigilance cell at the head office of banks to the RBI by 7th of the following month, to the financial information unit, to the financial intelligence unit, India by the 15th of the succeeding month, that is the next month, National Crime Records Bureau. So, this is the idea. Now, coming to the next question, try to answer this question. Yes, Nishant, if you have studied the March, April, and May in a thorough manner, then it is sufficient. In the context of RBI, Urban Cooperative Banks Concentration Risk Management Direction 2025, if a UCB meets the eligibility criteria for business authorization under the Urban Cooperative Bank branch authorization directions, then unsecured loans up to dash per borrower that qualify as priority sector loans will be excluded and not be counted while computing the total percentage ceiling on the total unsecured loans and advances. So here, if the unsecured loans are up to 50,000 per borrower that qualify as priority sector loans will be excluded and will not be counted while computing the 20% ceiling on the total unsecured loans and advances. So the ceiling on the total loans and total unsecured, the ceiling on the total unsecured, that is not backed by collateral basically. So total unsecured loans and advances, for that the ceiling is 20%. The ceiling is 20% for the bank. Okay. Now, ceiling on unsecured advances. So for the salary earner UCBs that come under the tier 1 category, for the salary earner UCBs that come under the tier 1 category, for them the unsecured loan limit for individual borrower and group borrower is decided on the basis of which two factors, if anyone can tell me? If anyone can tell me that which two factors are there according to which the unsecured loan limit for individual borrower and group borrower is decided? It is on the basis of the demand and time liabilities and the CRAR. Okay. So on the basis of the demand and time liability and the CRAR, the limit is decided the limit is decided for the individual borrower and group borrower for the unsecured loans. Okay. And the maximum limit is 5 lakh. Maximum limit is 5 lakh. Chalo. Now moving forward with the next question, what are the limits on unsecured advances to a single borrower by the tier 1 and tier 2 urban cooperative banks? What are the limits on unsecured advances to a single borrower by the tier 1 and tier 2 UCB? We have just discussed that the salary earner UCBs, they come under tier 1, and the maximum limit of unsecured loans that they are able to provide to the single borrower or group borrower is 5 lakh. This is what we have seen, that the maximum they are able to provide to the single borrower or to the group borrower is 5 lakh. That means for the tier 1, if salary earner UCBs are coming in tier 1, that means for the tier 1 5 lakh is the maximum. Okay. For the tier 2 UCB 7.5 lakh is the maximum. For the tier 3 and tier 4 UCBs, what is the limit on the unsecured advances to a single borrower? Anyone remembers? Anyone remembers? Yes, very good. 10 lakh. Very good, Divya. Now, how many like tier 1 and tier 2 UCBs they can provide the housing loans for a total period of how many years? For a total period of how many years, including the moratorium period? 20 years. 20 years. Okay. For a total period of 20 years. So housing loan can run up to can run up to 20 years in total, and the moratorium that is provided, that is for the period where the repayments will not happen during the construction, that can go maximum 24 months, not beyond that. Okay, chalo. So these are the limits on unsecured advances to a single borrower. Tier 1 5 lakh, tier 2 7.5 lakh, tier 3 and 4 10 lakh. Try to answer this question now. As per the expected credit loss framework prescribed under the Reserve Bank of India, commercial banks, asset classification, provisioning, and income recognition directions 2026, if a company has directors um, listed as willful defaulters, banks must keep an additional how much percent of provision on top of the normal expected credit loss if banks has exposure to such a company. So 5% is the answer. Very good. Additional provision of 5% has to be kept. So recently we have discussed the asset classification, provisioning, income recognition directions. Okay. Now, the additional provision rule is that if there is the willful defaulter, if a company has directors, if the company has directors and any of the director is listed as willful defaulter, bank must keep an additional 5% of provision. Now, the expected credit loss directions, they are going to come live from which particular date? That means that these directions are applicable from when? The effective interest rate, it will be effective from the same date for the new loans, but the old loans that are outstanding, they have to come under the effective interest rate from when, or till what time the outstanding loans should be brought under the effective interest rate. So the expected credit loss model, is going to be effective from 1st April 2027. Very good. 1st April 2027. The effective interest rate will also be applicable for the new loans from 1st April 2027. But for the outstanding loans, because they have a different contractual interest rate system. So for the outstanding loans that are the old loans, if they have to come under the effective interest rate, they have to be brought under the effective interest rate by 31st March 2030. That is from 1st April 2030, they should be following, all the loans should be following the effective interest rate. Okay. Now moving forward. Now, this is some additional article that was released, I think in April or May, this was released, that RBI has now extended the list by adding four more signs of financial difficulty. So, if this downgrade is happening in the financial instrument, significant change in the value of the collateral, if any delay in the payment of fee is happening, then there will be financial difficulty that will be considered. Okay. Now, coming to the next question. Water break, let's take it after 60 questions. Let's do 60 questions, then let's take a water break, even I require it. But let's take it after 60 questions. ठीक है, पहले 60 complete कर लेते हैं. Under the RBI Commercial Banks Credit Risk Management Second Amendment Directions 2026, if a bank is unable to properly assess unhedged foreign currency exposure, that is unhedged foreign currency exposure, and compute incremental capital, the exposure must be placed in the highest risk bracket, attracting an increase in risk weight by basically if the potential loss because of the unhedged foreign currency exposure is more than 75% of the earnings before interest and depreciation, then the maximum of the risk weight, that will be 25%. The additional risk weight of 25% will be applied. Below that there is no risk weight application. Okay, so 25 percentage point is the highest risk weight. 25 percentage point is the highest risk weight. This is it. Now here you can see that if the potential loss is from the unhedged foreign currency exposure, so if there is the unhedged foreign currency exposure, where the potential loss is happening less than 75%, so in this case, or equal to 75%, in this case, there is no increment in the capital requirement, no increment in the risk weight. But if the uh, potential loss because of the unhedged foreign currency exposure. There is the potential loss of more than 75%. In this case, the maximum of 25 percentage point increase in the risk weight that will be there. Now, try to answer this. The Reserve Bank of India, through amendments to the Commercial Bank Credit Card and Debit Card Issuance and Conduct Direction 2026, has prescribed that a credit card account shall be treated as past due for reporting to credit information companies only when the payment remains overdue beyond how many days. So basically, let's say today, that is on 6th of June, or let's say on 13th of June or 6th of June 2026, you had to pay your credit card bill. That was the last date. But because you were taking the marathon, you were attending the marathon, so you forgot. Now, on tomorrow, immediately the bank will classify you as non paying. No. So basically, it is said that at least 3-day time period should be provided beyond the beyond the date. 3-day time period should be provided before classifying it as a due and giving the information to the credit information companies, and before imposing the penalties from the date of due. Okay, so 3 days from the due date are provided. 3 days from the due date are provided. That is the idea. So a credit card account will be reported as past due to the credit information companies, or penalty will be levied from the date of due only if it remains unpaid for more than 3 days after the due date. Now, try to answer this question. So, under the Reserve Bank of India, commercial bank treatment of willful defaulters and large defaulters, banks are required to finalize the process of declaring a borrower as a willful defaulter within a maximum period of how many days from the date of NPA classification. So, after the NPA classification, if it has been identified that this particular borrower has willfully defaulted, the NPA has the asset has become non-performing asset because the person is willfully defaulting. So within 6 months, within a period of maximum 6 months from the date of NBA classification, if the willful defaulter has been identified, so it has to be informed. So 180 days. 180 days. Yes, 180 days. So 6 months. Okay? If willful default is identified at the internal preliminary screening stage, the bank must complete the process of declaring the borrower as willful defaulter. This process must be done within 6 months from the date of the account is classified as NPA. Now try to answer this. RBI allows provisions or loan loss reserves that are created for future and currently unidentified losses to be included in Tier 2 capital. The aggregate of such eligible items can be classified as Tier 2 capital only up to maximum of what? So these are the options. Basically here it has been said, yes. So basically here it has been said that if let's say you are keeping provisions, or the bank is keeping provisions, the bank is keeping provisions the bank is keeping provisions against the standard assets that have not turned into NPA, that have not turned into non-performing asset. So if the bank is keeping provisions under the standard asset, these provisions can be added into the tier 2 capital. So under the CRAR, there is the tier 1 capital, that is the most liquid capital that the bank has. There is the tier 2 capital. Okay, so the provisions that are for the standard asset, they can be kept under the tier 2. CRA requirement is 9%, tier 1 should be minimum 7%, and tier 2 can be 2%. Now, should like if the provisions are added in the tier 2 capital, they can be maximum up to 1.25%. They can be maximum up to 1.25% of the risk weighted asset. That is the idea. Okay. So Reserve Bank of India has issued commercial bank prudential norms in which it has been said that the provisions that are the loan loss reserves, the provisions, they are kept for the standard asset. They are created for future for the unidentified losses. So these provisions, they can be used as the tier 2 capital. They can be kept in the tier 2 capital, but up to the limit of 1.25%. Okay. So tier 2 capital is usually like 2% for the scheduled commercial bank. So in the tier 2 capital, a maximum 1.2% of the risk-weighted assets can be kept in the form of provisions. Now coming to the next question, try to answer this question. With reference to the RBI's Commercial Banks Transfer and Distribution of Credit Risk Direction 2026, when must the loss arising from transfer of stressed loans to asset recognition company be recognized? So basically, here the idea is that the RBI mandates that the loss must be recognized immediately in the same financial year in which the transfer take place. So let's say that the loan was transferred to the asset recognition company. That means the loss has happened immediately in the same financial year in which the transfer happens. So when must the loss arising from the transfer of stressed assets? If the stressed asset loan was of 100 crores, the asset recognition company purchased it for 20 crores. That means the loss of 80 crores has happened. The bank has to immediately recognize it. That is the idea. Okay? Yes, immediately, like there is no sense in waiting in this now. So as per the amendment direction, when a stress loan is transferred to the asset recognition company at a price lower than its net book value, the resulting shortfall shall be immediately recognized. So if let's say 100 crore was the loan amount and the asset recognition company is only able to pay 20 crore for that, so the bank is having the loss of 80 crores which have to be recognized immediately. Now, coming to the next question, this question can be difficult for some of you, but I will tell you the logic that you can apply. If you apply that logic, you will be easily able to answer this question. Okay. So, this question we will do after taking a small break of 2 minutes. So, let's take a break. Uh, Let me bring some more water for me. Okay. So, let's take a break of 2 minutes and then we will start with this question. So, right now it is 19. So, let's meet at 19:02. Till then, read the question, and if you are able to answer this question, try to answer this question. Just in 1 2 minutes, we will meet again. Okay. So I hope I'm again audible. Okay. So Kashish has given the answer. Let's see for the others also. Okay. So here, basically, HTM, held till maturity. Think about it, that held till maturity, that means you are holding the assets till maturity. Okay. The voice, is it clear? Or is there any issue that is coming? Audible. Okay. So see, held till maturity, these are the assets that are held till maturity. So they will not be calculated at the current price. They will not be seen at the current price. Available for sale, for these available for sale, they might be sold or they might be kept till maturity. Okay. FVTPL, they will always be taken at the fair value in through profit and loss. So HTM to AFS, HTM to AFS, AFS reserve. So fair value becomes new carrying value. So if the transfer is happening, if a asset that was held till maturity, if it is transferring to AFS, that is available for sale. So fair value becomes the new carrying value, the new value, and difference goes to AFS reserve. Okay. So whatever is the current value that will be taken, and the fair value, that is the market value, becomes the new carrying value, because the available for sale can be sold or can be kept till maturity, and the difference goes to AFS. So this is easy, A first ka B. Now HTM to FVTPL, that is fair value, profit and loss. So fair value becomes the new carrying value, and the difference goes to profit and loss. So profit and loss, FV TPL, the whatever difference is there, that goes to the profit and loss. So second ka A. AFS to HTM, that means now it will be held till maturity. So cumulative AFS reserve or gain or loss is reversed. So whatever gain or loss was there is reversed, because now the AFS is transferred to the HTM and adjusted to revised carrying value. Revised carrying value means the ultimate value that was when the bond was purchased or the asset was purchased. So 3 ka D. AFS to FVTPL. So AFS to FVTPL. So profit and loss, basically. This is profit and loss from the AFS to profit and loss. So first ka B, second ka A, third ka D, and fourth ka C. Okay. So here the answer is A. Here the answer is A. So this is the idea that usually what happens, that for these kind of transaction, like there are different kind of transaction, the held till maturity, available for sale, and the FVTPL. So held till maturity, these are the instruments that are kept till maturity. AFS, these are the instruments that could be kept till maturity, or they can be sold if the bank has the liquidity requirement. FVTPL, this usually includes all the other instruments, and it includes the held for trading instruments that are kept for trading. Okay. For the HTM, it will be seen at its own value at which it was purchased. So if a bond was purchased for 100 crores, at the end of the maturity, the bank will get 100 crores. So whatever is the initial value, that will be kept till the end also. AFS, now in this case, because the uh, sale can happen at any point of time. It might happen in the future, it might happen in the current period also. It might happen in the long term or short term. So for this, there is a AFS reserve that is kept separately. FVTPL, because this is the fair value through profit and loss, here the trade can happen at any point of time. So for these kind of instruments, the profit and loss account directly includes the transaction or the difference and such. So whenever the transfer is happening from HTM to AFS, so AFS reserve will be included, or from the HTM to profit and loss, fair value through profit and loss, the profit and loss will be mentioned and such. So this is the idea. Now coming to the next article, try to answer this. With reference to the Reserve Bank of India disbursement of government pension by agency bank directions, if there is a delay in crediting revised pension or pension arrears due to an error on the part of the bank, then what is the compensation that has to be paid? What is the percentage of compensation that has to be paid on the actual payment due? What is the compensation that has to be paid on the amount that is due? 8%. Very good. 8% is the percentage that has to be paid. Okay. So this is all that is written. Earlier government orders, like basically the government transactions, it happens through the banks, that are the agency banks. The agency commission, the RBI has to provide the agency commission and such. Now in this case, if the pension payment has to happen to the people, so the pension payment happens through the banks. Now if the pension payment has to be withdrawn by old, sick, disabled, incapacitated pensioners, in this case the thumbprint can be taken, but for the thumb impression, at least two witnesses should be present. Okay. And one witness should belong to the bank from the same branch, if it may. So two independent witnesses should be there. Or if let's say thumb impression can also not be taken, or the impression cannot be taken, so then a mark is taken, because let's say the person is incapacitated. So instead of taking thumb impression, then any mark can be taken. But in this case, if a mark is being taken from the pensioner for the withdrawal of money, then two independent witnesses should be present. Okay. This is the idea. Now if there is any delay happens on the pension payment, then the delay is on behalf of the bank. So 8% is the compensation that has to be paid on the amount that is delayed. Now coming to the next question, try to answer this question that if with reference to the Reserve Bank of India, with reference to the Reserve Bank of India, if the pension calculation and related work are carried out by the concerned government department or treasury, and the bank merely credits the pension amount into the pensioner's account through a single debit to the government account, for such transactions, what will be the agency commission? What will be the agency commission? That means the pension calculation and the related work has already been carried out by the concerned government department or treasury. The pensioner, the bank is only transferring the money to the pensioner because the calculation has been done by the treasury or the government department. Yes, 7 paise per 100 rupees. See, for the pension payments, where where the pension calculation and the related work is done by the bank and the transaction is also done by the bank, then in this case, in the case of pension payment, what will be the agency commission to the agency bank? What will be the agency commission to the agency bank? What will be the agency commission to the agency bank? It will be 80 rupees. It will be 80 rupees, right? But in case if the pension calculation and the related work are carried out by the concerned, if the pension calculation and the related work is carried out by the treasury or the government department, the bank is only transferring the money, it is not doing the calculation. In this case, the bank will only get 7 paise per 100 rupees. Okay, so this is the idea that first of all, agency bank can be a public sector bank, scheduled private sector bank, scheduled payment bank, or scheduled small finance bank. So public sector bank, private sector bank, scheduled payment bank, scheduled small finance bank, they can be agency bank. And these are the agency commission rate. Receipts physical mode, if the receipt of the money, if the money has been received, text receipts in the physical mode, 40 rupee is the agency commission. If the receipts are on e mode, electronic mode, then 12 rupee is the agency commission. Pension payments, if the bank is doing the pension calculation and the related work and doing the transfer of the pension also, then 80 rupees. But if the treasury is doing all this task, or the government department is doing these tasks, then the payment other than pension, under this the pension payment will be done by the bank. Okay, 7 paise per 100 rupee, this is the idea. And the number of pension transactions per year cannot exceed 14 transactions. Okay, and if the calculation is done by the treasury or the government department and only the transaction is from the bank, then this will classified as other than pension payment transactions. Now coming to the next question, try to answer this. Borrowers whose account are classified as standard, they are not in default. So according to RBI Resolution of Stressed Assets Amendment Directions 2025, borrowers whose account are classified as standard, they are not in default for more than 30 days as on the date of occurrence of the calamity. So some calamity has happened. Okay, there is the declaration of calamity that is happening. The implementation of the resolution plan for borrowers affected by calamity must be completed within dash days from the date of declaration of the calamity. So yes, 135 days. Now the this is the idea that the meeting should be held within how many days? So basically, if the calamity has happened, then the state level bankers committee or the union territory levels bankers committee, they have to conduct the meeting within 15 days. The invocation of the plan that we are conducting this plan should be done within 4 days, and the implementation should be completed within 135 days. This is the plan for the restructuring of the loan or for the betterment of the people that are hit by the calamity. Okay, so if they are not able to make the repayments because of the calamity, if they are not able to make the loan repayments, so there is the plan that is implemented. Okay, this is the idea. So here you can see that the state level bankers committee, union territory level bankers committee, the special meeting should happen within 15 days of declaration of calamity. So within 15 days of declaration of calamity, there should be meeting that should be conducted. Now, eligible borrowers for which the plan can be introduced for the resolution that can be provided to the borrowers. First of all, they should be standard borrowers. They should have standard account. They should not have become NPA before the calamity, and they should not be in default for more than 30 days on date of calamity or declaration. Invocation of the plan should be within 45 days of the declaration of the calamity, and implementation within 135 days. This is all that you have to remember, mota mota. Okay? The rest, just go through the diagram first once. Now, coming to the next article, read the question carefully and try to answer this. Which of the following statements correctly describes the provisioning requirement and norms under the Reserve Bank of India Income Recognition Asset Classification Provisioning Amendment Directions 2026 for loan structure due to officially declared calamities? So these are the officially declared calamities. So the bank must create an additional provision of 5% of the outstanding debt over and above the normal prudential provisions for the loans that are restructured. Okay, resolution plan is going on, the loan has been restructured due to officially declared calamity, so additional provisions of 5%, yes. If a borrower after restructuring pays at least 10% of the outstanding debt and the account continues to remain standard is not subjected to any further restructuring, the bank may write back the additional provisions. Is it 10%? No, it is 20%. That if the borrower after restructuring repays at least 20% of the outstanding debt and the account remains standard, it has not required any further restructuring, so the bank may write back the additional provisions, can return the additional provisions to the operations. If the borrower's outstanding post restructuring exposure is only in the form of non fund based facilities like the guarantee and such, the bank may reverse the additional provisions made after 1 year. That is also correct. So first and third are correct, second was wrong, and here you had to find the correct statements. So 1 and 3 is the answer, right? 1 and 3 is the answer. C is the answer here. Chalo. So basically, whenever even under the calamity, if the borrowers, let's say the borrowers, because of the calamity, because of the officially declared calamity, the borrowers, they are not able to repay the loan. So it is not like the fault of the borrower. So there is a resolution plan that we have discussed, that the resolution plan should be invoked within 45 days of the date of the declaration of calamity. Within 135 days, it should be implemented and such. Now here, the idea is that if the resolution plan, if the restructuring has happened, then the banks have to maintain additional provisions of 5% over and above the normal provisions. Okay? If the borrower returns 20% of the outstanding debt and the borrower has not slipped into NPA, there is no further restructuring that was required, and still the borrower was able to repay 20% of the outstanding debt, then the additional provisions can be written back. Okay, so this is the idea. Now coming to the next question, try to answer this. Under RBI's review of guidelines on inclusion of quarterly profits. So same quarterly profits, the quarterly profits to the common equity tier 1. The formula is eligible profit is equal to net profit minus 25%, that is 0.25 multiplied by the uh, average dividend in the past 3 years. Average dividend in the past 3 years. So 0.25 is 25%. So this is the answer. Okay? D is the answer here. Same. Eligible profit is equal to net profit minus 0.25 multiplied by the average dividend paid during the last 3 financial years. Now coming to the next statement, now coming to the next question. So try to answer this question. Okay. As per the Foreign Exchange Management Regulations 2026, authorized person. Now this is for the authorized person, that is for the authorized dealers. Okay. So as per the Foreign Exchange Management Authorized Person Regulations 2026, which of the following statements is correct in regards to the authorized dealer? So we are in the May articles now, April, May, yes, in the last months. As per the Foreign Exchange Management Authorized Person, that is for the authorized dealer, the regulations 2026, which of the following statements is correct in regards to the authorized dealer? A full-fledged money changer or a forex correspondent functioning for at least 2 years with an average annual forex turnover of 100 crores during the previous two financial year is eligible for authorized dealer category 2? 100 crores? No, 50 crores. Okay. Minimum net worth required for renewal of authorization for single branch full-fledged money changer. Net worth requirement is 25 lakh for the single branch full-fledged money changer. For multi-branch full-fledged money changer, for that multi-branch 50 lakh is the requirement, not for single. For single 25 lakh. Any non-trade current account transaction permissible under the act other than authorized dealer category 1, sorry, authorized dealer category 2 can undertake the non-trade current account transaction, that is basically the remittances of whatever amount the permitted activity for authorized dealer category 2 is the remittances that they can involve in, as well as the foreign trade transactions up to 25 lakh, up to 25 lakh. So all of these statements are incorrect. Now, in if the authorized person had entered into a franchisee arrangement and such arrangements was valid up on the date of these regulations came into force, the arrangement may continue temporarily but must be discontinued within 2 years, not 5 years, within 2 years. FFMC shall maintain the minimum annual forex turnover thereafter on an ongoing basis at 10 crores. So this is correct. All the other statements are incorrect. Only the E statement is correct, that the FFMC need to have the minimum annual forex turnover of 10 crores. Okay. Authorized dealer category 2 needs to have the minimum annual forex turnover of 50 crores. This is not for banks, not for NBFCs. Other authorized dealer category 2 need to have the minimum annual forex turnover of 50 crores. So authorized dealer category 1, a bank licensed by RBI. Authorized dealer category 2, a bank or NBFC registered with the RBI, a full-fledged money changer or forex correspondent functioning for at least 2 years with an average annual forex turnover of 50 crore during the previous two financial years. Okay. Authorized dealer category 3, for their own activities, they want to have the authorized dealer, like for their own business activities, for their own activities, they are undertaking the buy and sell of the foreign exchange. Net worth requirement for authorized dealer category 2, net worth requirement is 10 crores. For authorized dealer category 3, net worth requirement is 2 crores. Okay. Now, permitted activities. So authorized dealer category 2 can only undertake foreign trade transactions up to 25 lakh per transaction. The remittances, for the remittances there is for the remittances there is no such limit. Now, authorized dealer category 2 needs to have the minimum annual forex turnover of 50 crores. FMMC needs to have the minimum annual forex turnover of 10 crores from the commencement within 2 years from the date of coming into force of these regulations, or from the commencement of forex business, whichever is later. Chalo. Moving forward. Now, appeal, let's say the RBI has rejected the application for authorization or revokes an existing authorization. So you can appeal as a bank or as an authorized dealer, or as an applicant to the for the authorized dealer. You can appeal against the decision of the RBI, but the appeal should be within 45 days and the decision should be within 60 days. So the decision will be taken by the appellate authority within 60 days from the date of receipt of the appeal. Okay. So appeal should be within 45 days of the decision of the RBI, and the appeal should be within 45 days of the decision of the RBI, and the decision should be by the appellate authority. The final decision should be within 60 days of the appeal. Now, franchisees are not allowed now. Foreign exchange correspondent scheme has been launched by the RBI. So the franchisees, they have to close down after at least, like, they should be discontinued within 2 years from the date. My voice is low. Now is it fine? Now is it fine? Okay. Let me repeat. For this article, my voice was low, right? For this article, my voice was low. For this particular article. So remember that the authorized dealer category 1, the bank licensed by RBI. Authorized dealer category 2, it can be a full-fledged money changer or forex correspondent that is functioning for at least 2 years with an average annual forex turnover of 50 crore and is work like forex turnover of 50 crores for previous two financial year. Okay. Authorized dealer category 2 needs to have the minimum net worth of 10 crores, authorized dealer category 3 needs to have the minimum net worth of 2 crores. Okay, authorized dealer category 2 minimum net worth of 10 crores, authorized dealer category 3 minimum net worth of 2 crores. Next is that authorized dealer category 2 cannot take foreign exchange trade transactions more than 25 lakh. They can only undertake foreign trade transactions up to 25 lakh. Okay, so authorized dealer category 2, they can only allow the buy and sell the foreign currency for the foreign trade transactions up to 25 lakh. For the remittances, there is no such limit. Next is that for the annual forex turnover category 2, authorized dealer category 2 needs to have the annual forex turnover of 50 crores, and the full-fledged money changer, they need to have the minimum annual forex turnover of 10 crores, and they have to achieve it within 2 years from the date of coming into force of these regulations or from the commencement of forex business. Appeal mechanism. So let's say the RBI has rejected your application for authorization, or RBI has revoked the existing authorization, so you can appeal against the decision within 45 days. Within 45 days, you can appeal against the decision. Okay, the bank can appeal, or the authorized dealer or the entity which has sent the application for the authorized dealer, they can appeal within 45 days against the decision, and the appellate authority will finalize the decision within 60 days. So the appellate authority, a recent order will be provided by it within 60 days from the date of receipt of the appeal. Now, franchisees, if they are open, are they allowed to continue till how many years? Like, they should be discontinued after 2 years. So now the foreign exchange correspondent scheme has been launched by the Reserve Bank of India. They are going to be the agents of the authorized dealer category 1 and category 2. So the franchisees should not continue. They should be discontinued within 2 years. Now coming to the next one, who was appointed as the deputy governor of the RBI for a period of 3 years from the date of joining the post. So it was Rohit Jain. Okay, D is the answer here. So Government of India appointed Rohit Jain, Executive Director, as the Deputy Governor of the Reserve Bank of India. His appointment is for a period of 3 years from the date of joining. Next is that the Reserve Bank of India imposed a monetary penalty of 31 lakh for non-compliance with certain provisions of directions issued on Know Your Customer. Which bank was penalized by the RBI? It was Yes Bank. It was Yes Bank. Okay. So basically, Yes Bank was penalized for not fulfilling the KYC requirements. That's it. Nothing more you have to focus on here. RBI has signed a MOU on mutual cooperation in the field of central banking with which central bank? So the RBI has signed a MOU on mutual cooperation in the field of central banking in the field of central banking with which central bank? It is European Central Bank. It is European Central Bank. Okay. So B is the answer here. That RBI has signed a MOU with the European Central Bank for the cooperation in the field of central banking. Next is, as per the data on lending and deposit rates of Scheduled Commercial Bank released by the RBI, the 1 year median marginal cost of funds based lending rate increased to what? Now, this is the kind of question that, see, this is on the monthly data. This is on the monthly, like the monthly data was released, and in that, this was released. So, such kind of questions, like the monthly data, you can ignore. Okay, so the monthly data was released for the month of April 2026. Now, this is the question that I have brought to show you that if like monthly data, you cannot focus on all the monthly data. So, this you can ignore, just the trend I will discuss with you. That's it. Okay. So data on lending and deposit rates of Scheduled Commercial Bank with the decrease of repo rate from Feb 2025, the repo rate started decreasing from 6.5% to 6.25% by 25 basis point. The repo rate decreased. Then in April, also the repo rate decreased 25 basis point, that is 0.25%. Then in June, the repo rate decreased by 50 basis point, that is 0.50%. Then in December, the repo rate decreased further. So right now it is 5.25%. Okay. So the repo rate has been decreasing. With that, the interest rate was also affected. So weighted average lending rate on fresh rupee loans of Scheduled Commercial Banks stood at 8.40%. So the weighted average lending rate has reduced from February till April. So this is it. Now this is all the data that I don't think that you will be able to remember so much of the data. The monthly data was released for the export and import of the services also. So basically, this again, you don't have to remember that the services just they are higher. The export of the services they are higher than the import of the services. Okay, so in the service sector, we always have the surplus. We always have the surplus in the services. Okay. And again, for the credit also, all of this data was released. This was the monthly data of March 2026. So here, again, this is not required to be remembered. Just remember that agriculture and light activities, for that there is year on year growth that is happening in the credit. For the industry also, there is the growth. For the MSME also, there is the robust expansion of the credit. Credit also going to the large industry. So all the sectors, they are getting the sufficient credit that is required, or there is growth in the credit that is going to them. So here you don't have to remember the data. Here you have to remember the trend that there is the higher credit that is going or that is flowing to the different sectors. Among the major industries, infrastructure, all engineering, basic metal and metal product, all of these have got more credit. Okay. Credit to service sector was seen the highest growth. Numbers are not important, but the credit to service sector saw the highest growth rate, and especially in the sector of non-banking financial companies, trade, commercial real estate. Okay. Personal loan segment also, like it saw a good growth rate. Chalo. This is it. Numbers are not important. Like the monthly data, you cannot focus on at this point of time. The Mission Mode Capacity Building Initiative launched by RBI for strengthening the UCBs, Urban Cooperative Banks. We have been discussing about this particular initiative again and again and again. And this was in news in Feb also. This was in news in March, April also. So this is important. So the Mission Mode Capacity Building Initiative launched by RBI is Mission Saksham. Now the full form of Saksham is Sehakari, Sehakari Bank Shamta Nirman. Okay? Sehakari Bank Shamta Nirman. That's it. Next. Coming to the next question, as per the RBI's amendment directions on investment fluctuation reserve, this is the most recent topic that we have discussed in the Finance 360-degree session. So UCBs must build the investment fluctuation reserve until it reaches what minimum percent for the urban cooperative banks. For the small finance banks, for the regional rural banks, what is the percentage of the investment fluctuation reserve? What is the minimum percentage? 2%. For the urban cooperative banks, what is the minimum percentage of the investment fluctuation reserve? It is 5%. Now the investment fluctuation reserves have to be maintained for the AFS, for the FVTPL, including HFT, but the investment fluctuation reserve is not to be maintained for the HTM, that is held till maturity, because it is not required. The held till maturity, you will keep the assets till the maturity. That means there will be no fluctuation basically in the short run. So for these, against these instruments, you have to maintain the investment fluctuation reserve. Okay. For which category of banks, other than the commercial bank, for which category of bank the investment fluctuation reserve is not required? Payment bank, small finance bank, regional rural bank, urban cooperative bank. For which category of bank the IFR is not required? Other than the commercial bank, it is the local area banks for which the IFR is not required. Okay. So this is the idea for commercial banks. For the local area banks, the IFR is no longer to be maintained. Okay. For small finance bank, regional rural banks, payment bank, IFR requirement is 2%. For the urban cooperative banks, the IFR requirement is 5%. This IFR money will come, or the investment fluctuation reserves will come from where? From the net profit earned by selling the investment. Okay? For the rural cooperative banks, how much is the IFR that has to be maintained? 5%. I think it is of May. Now coming to the next question. In May 2026, RBI's total income during financial year 2025-26 increased by what percentage compared with the previous financial year? In May 2026, RBI's total income during financial year 2025-26 increased by what percentage compared to the previous financial year? So it increased by, total income increased by 26.42%. Total expenditure increased by what? Total expenditure 26.4% was enough. The total expenditure increased by anyone remembers? Total expenditure increased by 102.4%. This was given in the RBI annual report. So total, as per the RBI annual report, the total income increased by 26.4% and the total expenditure increased by 102.4%. Okay. Now, uh, see, in the 23rd meeting of the Central Board of Directors, it was said that the contingent risk buffer will be maintained at dash percentage of the balance sheet for the 2025-26. What is the contingent risk buffer for the 2025-26? What is the contingent risk buffer for the 2025-26? It is 6.5%. What is the range in which the contingent risk buffer falls? The contingent risk buffers is within the range of 4.5% to 7.5%. Okay? Chalo. What is the surplus that has been transferred to the government of India by the Reserve Bank of India? So Reserve Bank of India has transferred the surplus of 2,86,588 crores. Okay? So this is the surplus transfer that has happened from the Reserve Bank of India to the government of India. And what is the percentage increase of the surplus? What is the percentage increase in the surplus? Like from the last 2024-25 to 25-26, what is the percentage increase in the surplus? Around 6% increase in the surplus transfer, 6.7%. So basically, the surplus transfer to the government of India increased by 6.7%. For 2024-25, like for 25-26, for 25-26, the contingent risk buffer is at 6.5% of the balance sheet. But for the 24-25, what was the contingent risk buffer for 24-25? Like for the past financial year, it was 7.5% of the balance sheet. 7.5% of the balance sheet. Okay. Now, coming to the next question, which of the following statements is incorrect in regards to the counter-cyclical capital buffer framework? Try to answer this question. Very good, everyone. Chalo. Which of the following statements is incorrect in regards to counter-cyclical capital buffer framework? The amount of CCCB, that is counter-cyclical capital buffer, may vary from 0 to 2.5%. Incremental credit to deposit ratio for a moving period of 3 years is supplementary indicator for the decision. Yes. So the RBI can decide that the banks need to maintain even higher capital buffers so that the if in the future the RBI is expecting some problems that can be tackled. So counter cyclical capital buffers are those. It can be within the range of 0 to 2.5%. And the counter cyclical capital buffer, for that the main indicator, the RBI sees the main indicator as the credit to GDP gap. So credit to GDP gap, this is the main indicator in the CCCB framework in India and shall be used in conjunction with the gross non-performing asset. Okay. The supplementary indicator can be the incremental credit to deposit ratio for a moving period of 3 years. If the credit to GDP gap remains below 5 percentage point, banks will not be required to maintain CCCB. No, the lower bound is 3%. So for the credit to GDP gap, that is the main indicator according to which the CCCB requirement is seen by the RBI. So lower bound is 3%. If the CCCB, that is if the credit to GDP gap is going beyond 3%, if it is 3% or higher than that, then the RBI sees the requirement that the counter cyclical capital buffer should be maintained or not. Okay? So 3%. If the credit to GDP gap remains below 3%, then the banks will not need to maintain the CCCB. If the RBI decides to activate the CCCB, the RBI has to inform at least 4 quarters uh, as the lead time so that the banks can prepare to start maintaining the higher buffers. Okay? So all the other statements are correct, just the C1 was incorrect, and that's why that is the answer. So CCCB, that is counter-cyclical capital buffers that the RBI can ask the banks to maintain. It ranges between 0 to 2.5%. The main indicator is credit to GDP gap that falls like the lower bound is 3%, upper bound is 15%. And the higher the credit to GDP gap is, the higher the credit to GDP gap is, the more the CCCB will be. But the highest CCCB, the highest capital, counter-cyclical capital buffers can be 2.5%. Okay, that is the idea. Yes. Now, coming to the next article, that is with reference to RBI's operating framework for facilitating outward remittance services by non-bank entities through authorized dealer category 1 banks, which of the following statement is correct? So, with reference to RBI's operating framework for facilitating outward remittance services by non-bank, so basically authorized dealer category 1 banks, they can connect with non-bank entities through their website, through their software, through their mobile application, through their uh, web application. Okay. Through their platform, basically, the authorized dealer category 1 banks can provide services to the customers. What kind of services? Only the remittances can be taken. Okay, with the connection of the non-bank entity. So basically, before RBI used to provide the approval to the non-bank entities if they wanted to connect with the authorized dealer category 1 bank, but now RBI has said that no such approval will be required. So non-bank entities must obtain prior approval. Now there will be no need to connect with the authorized dealer category 1 bank. Remitters funds must be routed through the third party entities account in India. Remitter fund may be routed through the third party. No. The third party account should not be involved. Non bank current account transactions, yes, non trade current account transactions are allowed using third party. So only the remittances, that is the non trade. So in the current account, there is trade in services, there is trade in goods, and there is transfer payment that include the remittances. So trade, non-trade, that means that is not trade. So only the transfer payments, that is the remittances, they are allowed. Only the remittances they are allowed through the third party entity or through the non-bank entity. Okay, so this is correct. C is the answer. The third party entity alone is responsible for FEMA? No. Authorized dealer category 1 is responsible for the FEMA compliance, for the Foreign Exchange Management Act compliance. The framework complies to trade related? No. Only non trade, that is remittances. So, this is the idea that earlier non bank entities needed specific RBI approval, which is not required now. RBI has now removed the requirement of prior RBI approval. Okay? The authorized dealer shall remain solely responsible for ensuring. Now, authorized dealer is solely responsible for ensuring compliance with the FEMA regulation. The remittances shall be permitted only for fund transfers originated from the remitter bank account to the beneficiary bank account. Still, now is it clear? Am I audible? The voice is clear? Okay. So, should I repeat this or is it clear? Should I repeat this or is this clear? Basically, authorized dealer category 1 non-bank entities, before they required prior approval from the RBI to connect with the authorized dealer category 1 banks, but now they will not require such kind of approval from the RBI. Non-banking entities, they can provide their services, they can provide their web application software or their mobile application and to the authorized dealer category 1 banks, so that the authorized dealer category 1 banks through the platform can connect, that can connect with the beneficiaries, can collect the remittances or provide the remittances and such, can provide the services, but it should be non-trade related. Okay, chalo. Now coming to the next question. The Reserve Bank of India appointed Sri Gunveer Singh as the new executive director. He will look after the dash. He will look after the Department of Payment and Settlement System. Okay. So RBI has appointed Sri Gunveer Singh as the executive director. He will look after the Department of Payment and Settlement System. As per RBI's operational guidelines, the notified size of the US dollar INR buy sell swap auction to be conducted by the RBI for liquidity injection is? So these are the directions that are recently released. These are the directions that are recently released. Okay. So basically, RBI wants uh, to provide to have the liquidity injection. RBI wants to provide more liquidity in the market. RBI wants to provide more rupees in the market. Okay. For that, the liquidity injection has been conducted. Now, $5 billion is the liquidity injection. So here basically on a review of current and evolving liquidity conditions, it has been decided to conduct a US dollar INR buy sell swap auction of US dollar 5 billion for a tenure of 3 years. So for a tenure of 3 years, basically here what happens that RBI is buying the dollars and RBI will be providing the rupees. Later on, after 3 years, RBI will uh, give RBI is providing the dollars, right? Sorry, RBI is taking the dollars right now and providing the rupees. Okay, so this is the first leg of the payment that is happening. So in the first leg of the transaction, the bank will sell US dollars to the RBI. So RBI is taking the dollars and RBI is providing the rupees. So to enhance the rupee and enhance the liquidity in the market, to enhance the liquidity in the market. In the second leg, the RBI will return the dollars and will take back the rupees. In the reverse leg of the swap auction, rupee funds will have to be returned to the RBI along with swap premium to get the US dollars back. This is the idea. So right now RBI is taking the dollars and providing the rupees. After 3 years, RBI will take back the rupees and will provide the dollars. This is the idea. Chalo. Now here one more important thing is under the swap auction minimum bid size would be $10 million dollars and in multiples of $1 million. So the swap auction is for $5 billion. The swap auction is for $5 billion and this is for a period of 3 years. In the first leg of the transaction, the RBI will take the dollars, RBI will give the rupees, and after 3 years, RBI will return the dollars after taking back the rupees. Okay, so this is the swap auction that the RBI is conducting to provide the liquidity in the market right now because there is deficiency of liquidity that RBI is feeling, and there is the minimum bid size of $10 million and in multiples of 1 million. The swap auction is there. Now coming to the next question, there are near to 130 questions, so let's go a little faster now with reference to Reserve Bank of India. Okay, so these are the questions like after these questions like till 80 or 85, the RBI notifications questions are there till 90. After that there are 10 to 20 questions from the reports of RBI, mainly from payment system report and the annual report. Okay, that we will see. Then the finance current affairs. So with reference to RBI capital charge for credit risk, that is the RBI has released the directions, the new directions. So with reference to the Reserve Bank of India capital charge for credit risk directions 2026, which of the following statements is given above, which of the above statements are correct, is or are correct, that you have to tell. Okay, basically okay, under these directions what has happened that Reserve Bank of India stated that till now the banks, they were deciding their risk weights. The banks were deciding the risk weight on the loans. The banks were deciding the risk weight on the loans. Okay, because all the loans or the loans, they have some risk weight, they have some risk attached. The investment that the banks are doing, the assets that the banks are purchasing, they have the risk weight. Now the banks, they were deciding the risk weight on the basis of their rating based approach, internal rating based approach. Now RBI said that there will be a standardized approach that will have to be followed, and for that RBI has provided the risk weights. So till now what the banks were able to do, what the banks were doing, the banks were following or the banks were having, okay, so till now the banks were using the internal rating based approach. Okay, now the RBI has said that the standardized risk weights have to be followed so that for all the banking system there will be standardized rates. So claims on the central government shall attract 0% risk weight. claims guaranteed by the state government shall attract 0% risk weight? No, state. See, if the loan is given to the state government, that will have 0% risk weight. But if the claims are guaranteed by the state government, that will have a risk weight of 20%. Claims on ECGC shall attract 20% risk weight. So 1 and 3 are correct, and that's why the right answer here is C. Okay. So basically, the Basel Committee on Banking Supervision finalized the Basel III finalizing post-crisis reforms. After the crisis, the Basel III norms were released, okay, in December 2017. One of the key objective of these reforms that have been undertaken under the capital charge, basically, till now, the banks were following internal rating based approach. So RBI brought these capital charge regulations because till now the banks were following the internal rating based approach, where the bank was deciding the risk weights according to different criterias. But now RBI has said that RBI is providing standardized approach for credit risk. So RBI has followed the standardized approach for credit risk. Now these directions will be applicable from 1 April 2027. Commercial banks other than small finance bank, payment bank, local area bank. Okay. So commercial banks other than these categories, corresponding new banks and State Bank of India. So commercial banks, the corresponding new banks and the State Bank of India will have to follow these directions other than small finance bank, payment bank, local area bank. So here there should be a bracket. Now, next is the risk weight. So here you can see that the fund-based and non-fund based claims of a bank on central government. So if the claims are on the central government, risk weight is 0% because the loans, the guarantees will not have any risk attached. Claims guaranteed by central government will also have 0% risk weight. Claims of bank on the RBI DICGC will have 0% risk weight because RBI is involved directly now. Direct loan, credit overdraft exposure of banks to the state government. So if the loan is given to the state government, 0% risk weight. Investment by banks and state government securities, 0% risk weight. Okay. So claims guaranteed by state government. So if the claims are guaranteed by state government, so loan is given to, let's say, XYZ entity, the state government is just guaranteeing the claim. So here the risk weight will be of 20%. Claims on ECGC, 20% risk weight. If credit facilities are extended under schemes guaranteed by Central Guarantee Fund Trust for micro and small enterprises, Credit Risk Guarantee Fund Trust for low income housing, or individual schemes under the National Credit Guarantee Trustee Company, and such schemes are backed by an unconditional and irrevocable guarantee provided by the central government, risk weight will be 0%. Risk weight will be 0%. The additional information you don't have to follow. Like right now, just focus on the main idea. If a new guarantee scheme is launched on or after September 7, 2022. So if a new guarantee scheme is launched, for that also risk weight will be. When it comes to the other multilateral development banks, there will be risk weight. There will be different risk weight that will be there. Okay. So I will correct this PDF. Question number is 78. Okay. So for tomorrow, you will get the corrected PDF where you will be able to see this part also. So these are the risk weight have been clearly laid down for the different loans. Before, the banks were using their own policies or their own understanding. They were following the internal risk based approach. But now the standardized approach will have to be followed, and these are the standardized risk weight that have been provided. If the bank exposure to foreign sovereigns, foreign governments, and the foreign central banks. Okay? So exposure to other MDBs, so other multilateral development banks that are not in this category. So if the loan is given to the other multilateral development banks, so as per the ratings, there will be the risk weight that will be applicable. As per the ratings, the risk weight will be applicable. Okay? So this is the idea. Now coming to the next question, with reference to the capital charge directions according to the standardized approach, which of the given statements above is or are correct? Object finance. See, like the project finance, where the loan is given for the infrastructure projects, the real estate projects, the commercial projects, and such. Object finance is where the finance is given for, let's say, aircrafts for a particular object, for ship, vessel, aircraft. So this is object finance. Okay, project finance is for infrastructure projects, real estate project, commercial real estate project, housing real estate project. Object finance is for a particular object. The loan is given for purchasing aircraft or for purchasing ships, vessels, and such. So object finance under specialized lending attracts 100% risk weight. Project finance in the pre-operational phase attracts 150% risk weight. High quality project finance in the operational phase attracts 80% risk weight. Specialized unlisted equity exposure attract 400% risk weight. So here first, third, and fourth statements are correct. This you have to remember. Okay, this you will have to remember, especially the data for the questions. This is the important point. Okay, whatever data is in the question format, na, that is the most important points that you have to remember. Okay, so basically, for the object finance, it attracts the 100% risk weight. Pre-operational project finance attracts 130% risk weight, not 150%. High quality operational project finance, it attracts 80% risk weight. Speculative unlisted equity exposure attract 400% risk weight and such. So risk weight are given just here. You have to remember the risk weight. Now, this is all. Like in the whole direction, the risk weight are given for the different kind of loans, for the different kind of exposures, the risk weight have been given. Okay, general corporate exposure, if the unrated exposure is there to the corporates including MSMEs and NBFCs, if they are not for the specialized lending exposure, if they are not for some project, if they are not for some object, then the aggregate exposure is more than 500 crore. For such exposures, 150% will be the risk weight. Okay, this is the idea, that if unrated exposure, for the unrated exposure which is not for the specialized lending exposure, 150% risk weight. And this, remember, NBFC credit information sorry, core investment companies will always have a risk weight of 100%. Specialized lending, here object finance will have the risk weight of 100%. Pre-operational phase of the project finance will have the maximum risk weight of 130%. Operational phase, non high quality projects, risk weight of 100%. High quality projects, risk weight of 80%. This is the, this is what has been written. Now this is important. You know that for a bank, if the bank is investing in the equity of a non financial company other than a subsidiary, if it exceeds 10%, that means if the bank is investing in the shares in the equity of a non financial company other than a subsidiary for more than 10%, the risk weight will be 1250%. And I rechecked it in the RBI's website because I also like 1250%. That is like too much. But yes, the RBI has actually stated that if the bank is investing in the shares of a non financial company more than 10%, that means the bank is having some controlling ownership, or the bank is trying to have the majority or like major shares in a company. In this case, the risk weight will be directly 1250%. So this is again important. Equity exposure, for that risk weight 250%. Speculative unlisted equity, 400% of the risk weight. Subordinated debt and other capital instruments, 150% risk weight. Okay, now coming to the next question. I know that these directions seem complicated, but the idea is that the concept is easy. All the loans, all the exposure will have the risk weight. Now, what will be the risk weight, that you have to remember. So now let's read the statements and then let's try to answer this question. Small business includes an MSME or other business entity with turnover equal to or less than 500 crore. Okay. Claims included in regulatory retail portfolio shall have assigned a risk weight of 75%. Okay. An additional 5 percentage point of risk weight applies if the total loan outstanding is 3 crore or above. Thus, commercial real estate, residential housing exposure attract 150% of the risk weight. So in these statements, the fourth one is incorrect. What is the percentage here, that you have to remember? So basically, the small businesses includes an MSME or other business entity with turnover equal to or less than 500 crore. So this is correct. Claims included in regulatory retail portfolio shall be assigned a risk weight of 75%. Additional 5% of the risk weight for the total loan outstanding is 3 crore or more. CRE, that is commercial real estate, residential housing attracts 100% of the risk weight, not 150%. Okay, this is the idea. So retail exposure, claims included in retail regulatory retail portfolio shall be assigned a risk weight of 75%. The criterias are not very important here. Next is the personal loans. For that, risk weight 125% if the personal loans are other than education and such. So this you can read. Now, unrated exposure to MSMEs that meet the criteria of regulatory retail portfolio will also have 75% of the risk weight. Otherwise, other unrated exposure to MSMEs which are not meeting the regulatory criteria will have the risk weight of 85%. Unrated exposure to MSMEs having aggregate exposure from banking system of more than 500 crore shall attract a risk weight of 150%. So this is also important that MSMEs usually if they are under the retail regulatory portfolio, if they are classifying for that, their risk weight will be 75%. Otherwise, unrated exposure to MSMEs 85%. If they are having the total exposure of more than 500 crores from the banking system, then the risk weight will reach to 150% if they are unrated. Now, for the commercial real estate projects, there are the risk weight. You don't have to remember the whole tables and such. Just remember that additional 5% point of the risk weight for the total loan outstanding is 3 crores or above. Okay? For the housing loans. So now coming to the next question. As per the RBI, if specific provisions are less than 20% of outstanding amount, what will be the risk weight? As per the RBI, if special provisions are less than 20 crores. See, the banks are also maintaining provisions for the loans. The banks also maintain provisions. Okay? The banks are maintaining provisions. What happened here? Just give me a second. Let me open the file again. Okay. So as per the RBI, commercial banks capital charge for risk. Hmm. If specific provisions, see, for the loans, the banks are maintaining the provisions. At the same time, the banks are also against the risk weighted assets, against the risk weighted loans, the banks are also maintaining capital. So it has been said that if the banks are maintaining more provisions, then lesser capital or the lesser risk weight will be applied. Okay. So here, if the specific provisions are less than 20% of outstanding amount, then the risk weight on unsecured portion of NPA or stage 3 asset will be 150%. Will be 150%. Okay. So if the specific provision as percentage of outstanding amount, if the provisions are less than 20%, then the risk weight on the unsecured portion of NPA will be 150%. If the specific provisions are 20 to 50%, um, less than 50%, then the risk weight will be 100%. If the provisions are more than equal to or more than 50%, then the risk weight will be 50% on the unsecured portion. That is all. Chalo. Now coming to the next one. As per the Reserve Bank of India, as per the Reserve Bank of India, how many domestic credit rating agencies are permitted by RBI for risk weighing claims for capital adequacy purposes? 7. Directly, 7 credit rating agencies are there. Let's move forward with this. So there are 7 credit rating agencies. Okay, these are the 7 credit rating agencies for the domestic credit rating. For the domestic credit rating, okay, and their credit. It has been told that A will have 20%, A 20%, A 50%. So these are the risk weights that have been standardized. That have been standardized. Next is that for the international credit rating agencies, they will have the risk weight of like there are how many credit rating agencies that are mentioned for risk weighing claims on non-resident entities. So how many international credit rating agencies are mentioned for risk weighing claims on non-resident entities? So there are how many international credit rating agencies? I think 4 are there. Yes, 4 are there. SP, the Care Edge Global IFSC Limited only for non-resident corporates, Fitch, Moody's, and Standard and Poor's (S&P). Okay, these are the 4 international credit rating agencies. For them also, the standardized approach has been followed. Now, I think this will be the last question from this particular article. Under the Reserve Bank of India, Advances classified as capital market exposure other than direct equity exposure shall attract which of the following risk weight? So, capital market exposure, the exposure to the capital market, if the banks have exposure to the capital market other than direct equity exposure, so that will have the risk weight of 125%. So, this is the idea. And for the equity, I think it was 250%. Hmm. Okay. Okay. One more question. The rating agency should have reviewed the rating agency should have reviewed the rating at least once during the previous how many months for banks to use such ratings for risk weighing purposes. So basically, the rating agency should have reviewed the rating at least once during the previous how many months for the banks to use such ratings for risk weighing purposes. So I think 15 months is the answer here. Okay. Yes. Now, this is so basically, I have provided you the material that you can see here and try to just read through it. Try to just remember the most important point, that is for the retail, for the MSMEs, for the central government, state government. Those are the most important points. For the equity, these are the most important points. So the directions are very very lengthy, but I have provided the material and the explanation through which you can cover the directions in the shorter period of time. Chalo. Now, coming to the next article, as per the Banking Laws Amendment Act 2025, the maximum continuous tenure of directors of state cooperative banks and central cooperative banks, urban cooperative banks, was increased from 8 years to what? So, this was quite in news last year. This is again in news now. So, I hope you will be able to answer this question. The 10 years is the answer. B is the answer. Very good. Yes, B is the answer here. And see, what was happening that it was recognized some of the urban cooperative banks directors what they were doing, that for the short period of time they were leaving their position so that they can again join and then the continuous, because it is said that urban cooperative banks, it is said that the directors, they can continue for 10 continuous years as the directors of a urban cooperative bank, state cooperative bank. So 10 continuous years, for that they will continue, they can continue. After that, they will have to take the cooling off period of 3 years if they want to again continue as director in a particular urban cooperative bank. Now, because the continuous years are mentioned or continuous period is mentioned, so some of the directors, they were briefly resigning from office and then getting re-elected or co-opted to the board within a short period. So in this way, they were extending their tenure more than 10 years also. So here now RBI has clarified that the state cooperative banks, central cooperative banks, urban cooperative banks who completes 10 years of continuous tenure, they need to have the cooling off period of 3 years. And for calculating the period of continuous tenure, RBI has clarified that short interruptions will not break the continuity. Even if you are leaving your position for 2 months, for 6 months, for 1 year, if a director leaves the board but returns within less than 3 years, the earlier period will also be counted towards the 10 years of continuous period. So basically, the directors, they can continue 10 years, they can continue for 10 continuous years as directors. Okay. So the directors, they can continue for 10 continuous years, but after that they have to take a period of 3 years of cooling off to rejoin as the director. Now, in the continuous period, your earlier tenure will also be counted if for a short period you are leaving the position. So if a director leaves the board but returns within less than 3 years, the earlier period of directorship will also be counted while calculating the total continuous tenure. So your total continuous tenure, if it reaches 10 continuous years, then you will have to leave your position and the cooling off period is 3 years. Now try to answer this. Who has been appointed as the convener of the RBI Expert Committee for a quantum secure and adaptive financial ecosystem? So RBI has a expert committee for, that is QSAFE. Who is the director convener? It is Dr. Anil Prabhakar. So basically, the RBI has constituted an expert committee for a quantum secure and adaptive financial ecosystem, QSAFE. The committee will examine the benefits, risks, challenges of using the quantum technology in the financial sector. The FinTech Department Central Office RBI will provide secretarial support to the committee. The committee will submit its report within 6 months from the date of its first meeting. Members of the committee. So the Anil Prabhakar is the convener. The rest are the members. Shri Suvendu Pati, the CGM, FinTech Department of RBI, is the member secretary. Okay, terms of reference are given. Just read it once. Not very important. Review sectors, cryptography, bill of material, crypto agility, and such. Now, coming to the next question, with reference to the finances of foreign direct investment companies 2024-25, direct investment from which of the following countries together accounted for more than half of the sample companies? With reference to the finances of foreign direct investment companies 2024-25, direct investments from which of the following countries together accounted for more than half of the sample companies? See, majorly Singapore, USA, and Mauritius. We are getting a lot of FDI from these countries. Okay. So yes, this is the answer. So basically, companies with direct investment from Singapore, USA, Mauritius accounted for more than half of the sample companies. Then Japan, Netherlands, and United Kingdom were other major direct investment sources. So RBI has released the data relating to the financial performance of non-government, non-financial foreign direct investment companies. And here the data is based on the audited annual accounts of 3,100 companies. So this is the idea. Companies with direct investment from Singapore, USA, Mauritius accounted for more than half of the simple companies. Now, next is this question. Try to answer this question. RBI has released the directions for the NRIs and OCIs for the non-resident Indians and overseas citizen of India may invest on both repatriation and non-repatriation basis. So this is the question. Try to answer this. NRIs and OCIs may invest in government-dated securities other than bearer securities. Correct. Treasury bills are permitted instruments for such investment. Okay. Units of domestic mutual funds or exchange traded funds are permitted only if they invest less than 50% in equity. So this is incorrect. So units of domestic mutual funds or exchange traded funds are permitted only if they invest less than 50% in equity. Listed non-convertible redeemable preference shares or debentures are permitted instruments. Okay. So the rest is correct, but the third one was wrong. And that's why 1, 2, and 4 is the answer. B is the answer. So Reserve Bank of India had issued the master direction, Reserve Bank of India, non-resident investment in debt instruments. So non-residents, they can invest in the debt instruments in India. So the non-residents, they can invest in the debt instruments in India. Now there is the amendment that has been brought for the NRIs and OCIs, non-resident Indians and overseas citizen of India. They are allowed to invest in certain debt instrument in India. Now there are three categories basically: instruments allowed on both repatriation and non-repatriation basis. Government dated securities, treasury bills, units of domestic mutual fund or exchange traded funds provided they invest 50% or less in equity. Listed non-convertible redeemable preference share or debentures. Instruments allowed on repatriation basis only, that is NRI or OCI may invest without limit in the following instruments on a repatriation basis: bonds issued by PSUs, bonds issued by infrastructure debt funds, debt instruments issued by banks eligible for inclusion in regulatory capital and such. National pension system governed and administered by PFRDA. Now, instruments allowed on non-repatriation basis only. That means the money cannot be taken out. The money should be invested in the country only or has to be kept in India only. So, instruments allowed on non-repatriation basis where the money cannot be taken out. So, NRI, OCI may invest without limit in the following instruments on non-repatriation basis: national plan, savings certificates, authorized chit funds, and such. FPIs may offer government securities and non convertible debentures, bonds issued by an Indian company acquired in terms of these directions as collateral to recognized stock exchanges in India for their transaction in exchange traded derivative contracts. So basically, margin. Whenever the foreign portfolio investors they are doing the exchange traded derivative contracts, so derivative contracts, the settlement will of contract will happen after 2 months, 3 months, so whatever is the timeline of the contract. So the government securities and such can be given as margin, can be given as security basis. Okay. So that is the idea. Now, mode of payment to subscribe to debt instruments. So basically there are non-resident external account where the foreign earnings are kept in the Indian rupees FCNR, that is foreign currency non-resident bank account, where the NRI can keep foreign earnings in the foreign currency with India. Okay, so just read it once more to remember that which instruments are allowed on the non-repatriation and repatriation basis. Big instruments like the government dated securities, T-bills, mutual fund units. Repatriation basis only, like the bonds issued by PSUs, where the money is required, where the PSUs require the money and such. On the non-repatriation basis, the small, like the national plan, the authorized state funds and such. Now coming to the next question. Under the RBI's direction on risk management interbank dealings, authorized dealers are generally prohibited from undertaking foreign exchange derivative contracts involving INR with their related parties. Which of the following is an exception to this prohibition? Fresh speculative derivative contracts with related parties? No. Cancellation and rollover of existing contracts with related parties? So, see, if the cancellation is happening or rollover of existing contract is happening, that is actually allowed. So, the derivative contracts with the related parties, this is allowed if there is, and the transactions are allowed. Okay, but there is the like. That is if the rollover is happening, if the extension of timeline is required, or if there is cancellation that is happening, so these are allowed. So, speculative derivative contracts are not allowed. All foreign exchange transactions with related parties without restriction are not allowed. There are certain restrictions. Derivative contract with related party for capital market investment not allowed. INR derivative contracts and such not. So basically, in February, there were directions that were released that authorized dealers. So these were the directions in February, that authorized dealers shall not offer non-deliverable derivative contract involving INR, and they cannot undertake transactions with their related parties for the derivative contracts involving INR. Okay, but these directions have been withdrawn. So that's why the Feb directions you don't have to study. Only the thing is that this is the recent in May, this has been stated that it has been decided authorized dealers shall not undertake any foreign exchange derivative contract involving INR with their related parties. So it has been clarified that the authorized dealers, they are basically prohibited, they are generally prohibited from undertaking foreign exchange derivative contract involving INR with their related parties, but there is certain exception that is provided. The exception is in case of the authorized dealers may undertake cancellation and rollover of existing contacts or contracts with related parties. So if there are existing contracts, it has now been said that from future onwards there can be no contract for the future, or there can be no direct contract, but the cancellation of the older contracts, or the rollover of the existing contract is allowed. Second, authorized dealers may undertake transactions with related parties if such transactions are done with non-related non-resident users on a back-to-back basis. So basically, let's say the bank, authorized dealer bank, it is doing a transaction, a derivative contract involving INR with the non-related non-resident user, with some non-resident. So the John Co Limited has said that it requires rupees. It will give the dollars. It requires rupees for its imports that it wants to do. Okay. Now the authorized dealer bank has done this contract that okay, the John Co Limited will provide dollars and the bank will provide the rupees. Now the authorized dealer bank, it can do back to back transaction, means back to back basis means the authorized dealer enters into one transaction with the customer, that is Jonco Limited, and another contract with some other party to offset or cover the risk arising. Okay, so the bank will have to provide the rupees. So will it have sufficient rupees with itself at that point of time? For that, it has done a contract with the other party. So in this case where the back to back transactions are involved, in this case the related party can be involved in the transaction. Okay, so where the back to back basis of the transaction is involved, that the authorized dealer bank is doing the transaction with a non resident user, and here for covering the position, the contract can be taken from the related party. That is the basic idea of these kind of contracts are involved. Now coming to the next question. Under the first phase of India Cambodia payment connectivity launched in June 2026, Indian travelers can make QR code based payments in Cambodia through collaboration between NPCI International Payments Limited and which Cambodian bank? Try to answer this. So recently in the Finance 360 we have discussed this. This is again released in June. So this is important. Ecleda Bank PLC. So this is the answer. C is the answer here. Okay. So basically, the India and Cambodia, the as part of the initiative, the connectivity of the payment system between India and Cambodia for acceptance of UPI at QR code enabled merchants in Cambodia. So for this, the NIPL, that is NPCI International Payment Limited, and the Ecleda Bank PLC have done the collaboration, have done the collaboration. Okay. So the National Bank of Cambodia and RBI, under the aegis of the RBI and National Bank of Cambodia, the NIPL and the Ecleda, they have done the collaboration. Chalo. Now, coming to the next question. In view of the inflation growth dynamics, the Monetary Policy Committee continued with its easing cycle by reducing the policy rate cumulatively by what basis points in 2025-26, lowering the repo rate to 5.25%. So here directly you can see this has been mistakenly added here. Directly in the financial year 2025-26, what was the decrease in the repo rate? What was the decrease in the repo rate? What was the basis point decrease in the repo rate? 100 basis point decrease in the repo rate happened. So if it is said that from Feb 2025, what was the decrease in the repo rate? By how much basis point? 125 basis point. But in the financial year of 2025-26, that is from April 2025, what is the decrease in the repo rate? Then it is 100 basis point decrease in the repo rate. Remember this. Okay? So 100 basis point decrease in the repo rate has happened. Now, coming to the now the Monetary Policy Committee meeting of June has happened, and in that June monetary policy, see the last Feb 2025, the repo rate was decreased from 6.5% to 6.25%. Then in April 2025, the repo rate was decreased by 25 basis point. In June, the repo rate was decreased by 50 basis point. Then in December, the repo rate was decreased by 25 basis point. Okay, so this is the decrease of the repo rate that has happened from 6.5% to 5.25%. Now, in the June Monetary Policy Committee meeting, it has been decided that to keep the repo rate unchanged at 5.25%. So MSF and bank rate, they are at 5.5%, and the SDF is at 5%. Okay, the next, try to answer this, that despite emerging challenges, so as per the June Monetary Policy Committee meeting that concluded yesterday, so despite emerging challenges such as elevated energy and commodity prices, supply chain disruptions, deficient southwest monsoon forecast, and weak global demand, and the Indian economy is expected to be supported by resilient private consumption, sustained investment activity, global, so even if the volatility, or even if the global supply chain disruptions are happening, global circumstances are worse for our country, but at least due to the domestic consumption pattern, due to the sustained investment activity at the domestic level, we are able to sustain. Okay. So in this context, what is the projected real GDP growth rate for India 2026-27? So real GDP growth rate for 2026-27 is 6.6% as per the June Monetary Policy Committee meeting. For the what was the real GDP growth for 2025-26 as per the annual report? What was the growth rate of 2025-26? Real GDP. What was the real GDP growth rate for 2025-26 as per the annual report? It was 7.6%. Now for 2026-27, it is expected to be down at 6.6%. So remember this. Okay? Yes. So this is the update that has happened, that domestic economic activity remained largely steady. Merchandise export, that is good export, recorded strong growth in April 2026, though elevated freight and the insurance cost remain a drag. So services export continue to be robust. The strains are increasingly becoming visible. Elevated energy and other commodity prices, continued supply chain disruptions, import diverse. So these are the problematic situation. We are focusing on import diversification in affected commodities, but the cost is high, because if we suddenly, like right now, we are importing the product at rupees 20, we are able to import the product at rupees 20. Now think about it, that in the, if we are doing the import diversification, we are producing it in our country, we are able to produce it at rupees 40. So import diversification is happening in the affected commodities. Due to the supply chain disruption, we are focusing on producing the product in our own country, but at the higher cost we are able to produce. Southwest monsoon is expected to be deficient, so this will create problem in the agriculture space. Okay. Though there are different schemes, initiative for crop diversification, water harvesting, conservation, and such, sustained momentum in services is also there. GST rationalization steps have been taken by the government. So real GDP growth for 2026-27 is projected at 6.6%. Quarterly data you don't have to remember. Just remember that in the first quarter and in the last quarter, the growth is more stabilized. Now, coming to the next question, headline CPI inflation increased in March and April 2026 mainly due to higher food inflation, while rising global energy prices, recent increase in the retail petrol diesel prices are expected to exert additional inflationary pressure. So, as well as there is also the further risk from the global supply chain disruption, monsoon uncertainty persist, as it has been said that the south uh, monsoon, southwest monsoon, sorry, is expected to be deficient. So in this backdrop, what is the projected CPI inflation for 2026-27? So in 2025-26, what was the CPI inflation? Now in 2026-27, the CPI inflation is expected at 5.1%. Okay? So CPI inflation is projected at 5.1% now. Now in 2025-26, the CPI inflation was 2.1%. Sorry. Yes. So this is the idea. Headline CPI inflation inched up to 3.4%, 3.5%. Okay? In March and April, primarily due to the food inflation, fuel inflation remained modest, but slowly and slowly the fuel prices have been raised cumulatively by 7.4% for petrol, 8.4% for the diesel, due to which the headline inflation is increasing, and the CPI inflation for 26-27 is projected to be 5.1%. So for 2025-26, the headline inflation was 2.1%. Now it is expected to be 5.1% in 2026-27 because of all these disruptions that are coming. Quarterly data you don't have to remember, it is just given to remember or to notice that the highest inflation we are expecting in the third quarter. Chalo. Now coming to the next. So the MPC also decided to retain the neutral stance. So neutral stance, we have been in neutral stance since June 2025. Yes. As per the RBI annual report 2025-26, dash was the headline inflation rate in India during 2025-26 as compared to 4.6% in 2024-25. So already discussed that the headline inflation rate in 2025-26 was 2.1%. So E is the answer. WPI inflation moderated to 0.7% during 2025-26. Now, coming to the next point, as discussed in the RBI annual report, this point was also in the PIB in Feb, I think, Google announced the establishment of an AI hub in which Indian city? In Vishakhapatnam. Okay? So, Google has announced the establishment of an AI hub in Vishakhapatnam with an investment of around $15 billion, and Tata Group has announced an investment of $11 billion for an AI innovation city in Maharashtra. Yes, PIB Feb. Urbanization in India, percentage of population residing in urban areas is projected at 40.7% by 2031 as per the 16th Finance Commission report 2026. Sorry. Next is as per the RBI annual report 2025-26, which BIS Innovation Hub led multilateral initiative did the RBI join for enhancing cross-border payments through CBDC. So Project Nexus, the RBI has already joined the Project Nexus. Last year, I think this project was joined by RBI. This is the project of BIS Innovation Hub, which focuses on the fast payment systems and the multilateral connections in the fast payment system. For India, the fast payment system is UPI, that we are bilaterally connecting with Singapore's Pay Now and the different fast payment systems. So through the project Nexus, the fast payment system of multiple countries could be joined. Now the India has also joined the BIS Innovation Hub led multilateral initiative for the cross-border payments through CBDC, that is Project Rialto, as well as RBI has also joined the phase 2 of Project Mandala. That is for the same purpose for the cross-border payments through CBDC. Okay? So we have also joined, RBI has also joined the phase 2 of Project Mandala. So Project Rialto and the Project Mandala. Next is as discussed in RBI annual report, which countries recorded the top three highest returns. Now, this particular point, it is not given directly in the annual report in the content, it is given through the diagram. So, this is some additional point that I am discussing with you that were through the diagrams. Okay. So Brazil, Japan, and Mexico. As discussed in the RBI annual report, which countries recorded the top three highest returns on global equity indices during 2025-26? Brazil, Japan, and Mexico, and India was in negative. So top three performance in terms of returns on global equity indices: Brazil, Japan, Mexico. After that, South Africa. India was in negative. Now, coming to the next question, according to the payment system report. Now, coming to the payment system report, I've only brought a few questions to discuss with you the most important points. More like the payment system report is again a lengthy report of 80 plus pages. So you like the whole report, I can take a detailed session on that, but because of the annual report, we don't have time now. I will see if I can take a session on Tuesday maybe, but that will be very near to the exam, so let's see. But here I've brought some questions, and in the Maha Marathon session for the all current affairs also I will bring some questions, so that at least some important points can be covered. Okay, and if the question has to come from the important points, at least you will be able to answer. Now, according to the payment system report, that is the half year ended December 2025, UPI had the highest share in the transaction volume during the second half of the 2025. What was its share? So in the annual report, it is mentioned to be 86%. In the retail payments, the UPI share in the retail payment is 86%. Here also it is 85.5%, so that you can remember. Next is, so here half yearly, this is the payment system report, is the half yearly report where the data is released for the India's changing payment system landscape. Payment Regulatory Board, this is the board that we have discussed also. The first meeting happened in January. Now, this payment regulatory board has replaced the earlier board for regulation and supervision of the payment and settlement system. Now, India's digital payment ecosystem has expanded impressively over the 10-year period. In the most recent 5-year period, the transaction volume grew by more than 4 times, and values nearly doubled, resulting in compound annual growth rate of 43% in volume and 17% in value. Now, such kind of data you might not be able to remember, so do not focus on this particular data. Here, what you have to focus on is that for transaction volumes and value increased for all the different payment categories, for RTGS, retail payments, for the digital payments and such, but for the paper based instruments, the transactions decrease. So all categories show an increasing trend of the volume and value transactions, except the paper based instrument. So this is important, that only in the paper based instrument there is the decrease in the volume and value of transaction. Okay, so only in the paper based instrument there is the decrease in both the volume and value of transaction. Next is, yes, the UPI has the highest share in volume of the in the transaction volume, 85.5%. NEFT and PPIs, NEFT and prepaid payment instrument followed with 3.6 each. Then RTGS, a very small share. RTGS has the highest share in transaction value at 68.6%. So when it comes to transaction volume, the UPI has the highest share of 5.5%. But when it comes to value, when it comes to transaction value, so when it comes to volume, UPI, when it comes to value, then it is RTGS. Then it is RTGS. Okay. So transaction volume, UPI, transaction value, RTGS, because through the RTGS real time gross settlement, the large payments that happens, right? That is transacted. After the RTGS in the value, then there is NEFT, then there is UPI. Okay, in the transaction volume, UPI, then there is then there is NEFT and PPIs. Top three you can remember. Now, upward trend has been seen in credit card, debit card, PPI wallets, UPI, QR codes. Decline was seen in PPI cards, point of sale terminals, bank owned ATMs, as cash recycler machines, micro ATMs. Now, coming to the next question. So I'm just telling you the most important points. I know that the time is less. That's why I just focus on the most important points for now. According to the payment system report, half year ended December 2025, how many central counterparties has the RBI authorized under the Payment and Settlement System Act 2007? Central counterparties, basically they are in middle of the buyer and seller. So central counterparty, it acts as the seller for the buyer and buyer for the seller, so that the transaction is settled. Even if the buyer defaults, then also the seller gets the product, oh sorry, money, then also the seller gets the money and such. Okay, so the transaction is completed. Even if the seller defaults, then also the buyer gets the product. So whatever the central counterparty is the party in between, it is the intermediary that helps in the settlement of the transaction. Okay, so in total there are only two central counterparties that have been authorized by the RBI under the Payment and Settlement System Act. Okay, so the two central counterparties are CCIL and ARCL. CCIL and ARCL. Now, the key practices under the PF, under the principles for financial market infrastructure. So the CCP, I have told you, it is the central counterparty that is in between the transaction, so that it works as the seller for the buyer, buyer for the seller. Okay. So as per the principles for financial market infrastructure, basically, the central counterparties follow the PFMIs, which are 24 risk management principles issued by the CPMI and IOSCO. These are the same names that we discussed in the terms of UTI when we were discussing about UTI. So remember that these same names you have to remember in context of the CCPs also. Margin regime is two-tiered, that initial margin has to be maintained and variation margin has to be maintained. Okay. So liquidity standards, CCPs must maintain enough liquid resources to settle the obligations, so that even if there is the default that is done by one party, the CCP is able to do the settlement. The default waterfall, CCP own capital is involved in the process. Chalo. CCPs in India, we have, sorry, RBI has allowed or authorized two CCPs, CCIL and the ARCL. CCIL is the older one and the ARCL is the newer one. Okay. Now, try to answer this question. After this, we are going to start with the finance current affairs. Finance current affairs, we will go in a faster manner because we don't have to discuss too much in length. Okay. According to the payment system report, half year ended December 2025, what is the maximum value of gift prepaid payment instruments? According to the payment system report, half year ended December 2025, what is the maximum value of gift prepaid payment instruments? So maximum value of gift prepaid payment instrument is 10,000. Okay. This is the answer. So see, here different authorized payment systems have been discussed. So RBI, RTGS and NEFT comes under RBI. The NASH, IMPS, UPI, APS, NECT for the toll payments, Bharat Bill Payment System, checks to an extent, the cards and such for an extent, they come under the NPCI. Other payment system operators, they are operating trades, PPI, MTSS, that is for the inward remittances and such. So you can read about them. RTGS, it was launched in 2004. This will help you in your static, in your phase 2 also, as well as for phase 1 also we have seen such kind of questions. So RTGS launched in 2004 and the transaction amount is minimum 2 lakh, maximum no limit. For NEFT there are 30, like half hour, 30 minute, sorry, half hour, 30 minute batches that happen. So NEFT transaction, it happens real time gross settlement, it is happening in real time basis because the bigger amount transaction is happening. For the NEFT, there are half hour batches that are there. Okay, half hour batches, that is for 30 minutes the batches are there. NASH is developed and operated by NPCI for bulk and repetitive payments. IMPS, that is 24/7 fast payment system introduced by NPCI for instant fund transfer, person to merchant. UPI, we all know UPI, multiple uh, improvements have been introduced in the UPI. Card payments, debit cards are mainly issued by banks, and while credit cards are issued by banks and a few non-banking financial companies. PPI, small PPI, limited KYC, further classified based on cash loading facility. Full KYC PPI, more features, higher transaction limit. Gift PPI is non reloadable. Gift PPI is basically a voucher, you can understand, with a maximum value of 10,000. Okay. A PPI for mass transit system, that is reloadable and capped at 3,000, like the cards. Then the trade bill, Bharat Bill Payment System is there for the bill transit, for the bills payment. Trade receivables discounting system, this is for the MSMEs, micro, small and medium enterprises, so that their bills can get discounted. Okay, Aadhaar enabled payment system, you have to give your Aadhaar card, you have to give your biometric to do any kind of like basic transaction, and such. This is it. Now coming to the next question. Now we are starting with the finance current affairs. Now, finance current affairs, see, I will suggest you that for RBI notifications and finance current affairs, I have taken the monthly revision sessions also. That also you have to see, or you should be seeing, because the more questions you answer, the more questions you solve, the better it is for the phase 1. you have to solve 80 questions in a limited time, or at least you have to see the 80 questions in a limited time. So you should be like answering and attempting a lot of questions. Okay. So for finance current affairs, I have brought the questions from the most important articles from your March, April, and May, and we are going to focus on May more. SEBI has proposed allowing, so we are starting with May first. In the finance current affairs, we are going ulta from May, then April, then last March. Okay. So we will go in a faster manner. I might sound that I am going in a rocket speed, but we have to go fast now because it is like too much time. SEBI has proposed allowing online bond platform providers to offer products, securities, or services regulated by which authority. So right now, the online bond platform providers, they provide the bond, the products, the securities, the services that are regulated by RBI, SEBI, IRDI, and PFRD. And now SEBI has proposed to allow the IFSCA, under the IFSCA, whatever products, securities, and services are regulated, that should also be provided through the online bond platform providers, as well as it has also been said that the tax saving bonds, they should also be allowed through the online bond platform providers. Now, the tax saving bonds are the bonds of which particular companies, I hope the course students at least remember that the tax saving bonds of which particular companies will be allowed under the OBPPs as per the proposal, the PFC and REC. Okay. The Indian Railways IRFC also. So basically, SEBI has proposed allowing the OBPPs, that is online bond platform providers, to offer products or services regulated by IFSC also, and certain tax saving bonds also under the Income Tax Act. So currently, OBPs can offer products or securities or services of the different regulators, just not IFSC. So for the IFSC also, like the IFSC regulated products should also come under the OBPPs. That is the idea. It has been said that as per the section 54 EC or the section 85, these bonds, that is the Indian Railways Finance Corporation, Rural Electrification Corporation Limited, and Power Finance Corporation, these bonds, they should be brought in the OBPPs, so that the investors can easily invest through the online bond platform providers in these bonds of these companies that are the tax saving bonds. Now, it has been clearly said that the tax saving bonds, if the customer grievance is there, then it will not come under SEBI purview. If it is the tax saving instrument, the investor grievance for such bonds has to be taken by the company directly. Okay. Now, coming to the next question, that is, which of the following is not a stated feature of or objective of the NSE's electronic gold receipts? Basically, it has been said that this electronic gold receipt, the investors can invest in the electronic gold receipt. They are basically purchasing, let's say, some gold, and they are purchasing the gold, but they are getting the receipt only, not the physical gold. The physical gold will be kept in the SEBI. Sorry, just a second. So basically, EGRs, the National Stock Exchange has said that the EGRs will be allowed. This is the electronic gold receipts. These are the receipts. Like, say you have purchased a portion of gold, some grams of gold, 50 grams of gold. Okay. So this against these, you will not get the physical gold. You are getting the electronic gold receipt. The physical gold will be kept in the SEBI accredited vaults, and let's say you can sell these receipts in the secondary market. As the price of the gold increase, your value of this EGR will also increase. If later on you want to transfer the EGRs into the physical gold, that you can do with a fee. Okay. Now, the against this EGR, interest will not be provided because these are not bonds, these are the receipts only. You are basically purchasing the gold which is kept in the physical manner in the SEBI accredited vaults. So guaranteeing a fixed annual interest, no. Integrating gold into the formal financial system by the NSE, yes. Enabling seamless conversion between physical and digital formats, yes. Enabling investors to participate even with. Just give me a second. Okay. So here, see, SEBI has proposed aligning its securitized debt instruments framework with RBI directions by permitting single asset securitization for RBI regulated entities. This is done by exempting them from the requirement that no single obligator should account for more than what share of the asset pool. So it has been said that, see, under the RBI directions, there is no limit of the borrowers for the shared asset pool. Okay? Under the securitization of receipts. So here the answer is 25%, first of all. Okay. So basically, under the securitized transactions, what happened that the multiple loans can be merged, like can be pooled together, and these loans, they are converted into securities. They are converted into securities to be sold to the investors. Okay. Now, these securities can be sold to the investors. As per the SEBI regulation, a single loan or a single borrower's asset cannot be more than 25%. So no single obliger, no single borrower should account for more than 25% of the asset pool. Okay? But RBI has not limited such kind of thing, or RBI has not said such kind of thing. Okay? So the regulated entities, that are the banks, NBFCs, they have to follow the directions of the RBI also. They have to follow the directions of SEBI also for the securitization of for the securitized transactions, for the securitization. So now it has been said that the regulated entities, SEBI has proposed that the regulated entities can only follow the directions of the RBI, and the SEBI directions, they will not be applied on the regulated entities. So as per the SEBI, for the asset securitization, when the loans or the debt instruments, if they are if the loans are pooled together, converted into securities to be sold to the investors, or debt instruments, they are pooled together to convert into securities to sell it to investors. So basically it was said that no obliger, no borrower should account for more than 25% of the asset pool. But this kind of limit is not applicable for the regulated entities. This is the proposal, because the RBI has not uh, imposed such kind of limit. Okay? So the existing condition restrict the listing of such instruments, and the RBI regulated entities, they do not have to fulfill this 25% of the limit. So basically, RBI regulated entity, let's say the regulated entity, the bank has given an infrastructure loan, a single infrastructure loan. That means a single borrower's infrastructure loan can also be securitized. The 25% wala limit on the borrower is not applied on the RBI regulated entities. Okay? The rest you can read, nothing much important here. The most important point is that 25%. Voila. Now coming to the next question. So yes, SEBI has also brought the rules and regulations on the securitized debt instruments, on the securitized instruments. The RBI has also brought regulations for its regulated entities on the securitization process. So the SEBI has said that the regulated entities can follow the rules and regulations of the RBI, because the regulated entities, the banks and BFCs, are under the regulation of the RBI. So the SEBI has imposed 25% limit, that a securitization process or the securitization transaction cannot have more than 25% of a single borrower asset. Okay? But or a single borrower loan. But in this case of the regulated entity, this limit will not apply. Now the FDI, for the insurance sector, the FDI has been made 100% for the automatic route. Through the automatic route, the insurance companies can accept 100% of FDI, or the equity investment, as well as the LIC. But the LIC has a stricter cap of 20% only. So through the automatic route, the LIC can only accept the FDI of 20% only. So here the answer is C. Here the answer is C. So this is the table that you have to remember, that for the insurance company, the equity cap or the FDI cap is 100% now through the automatic route. Through the automatic route. But for LIC, there is only 20% through the automatic route, only 20% of FDI or the investment can be accepted in the equity. For the insurance intermediaries also, 100% of the FDI can be accepted through the automatic route. But if the banks are doing the bank assurance, like they are working as the agents of the insurance companies, the banks are selling insurance products on behalf of some insurance company. If the bank has more than 50% of its revenue generated from non-insurance activities, from the banking activities basically, then the bank will not come under the insurance intermediary category of this 100% FDI investment. Okay, so basically banks acting as insurance intermediaries will continue to follow sectoral caps that is applied on the banking sector, applicable to the banking if more than 50% of their revenue is coming from non-insurance activities, that is basically from the banking activities. If they are earning more than 50%, then they will be under the FDI rules of banking, not insurance. Coming to the next question, NPCI Bharat Bill Pay Limited has partnered with which fintech firm to roll out a switch and SDK for its banking connect platform so that the payment aggregators they can easily connect with the net banking platforms of the multiple bank. So payment aggregators, basically they are the intermediaries that are providing the merchants the interface so that they can collect the payments from the customers through UPI, through the wallets, through the credit card, debit card, through the net banking also. So payment aggregator can connect with the net banking uh, of the multiple banks through the switch and SDK, by connecting with the banking connect platform, that is Bharat Bill Payment System platform. Okay, which fintech firm, NPCI Bharat Bill Pay Limited has partnered with JustPay to roll out the switch and SDK for its banking connect platform so that the partners can easily join the banking connect platform through which they can join the net banking, or they can get access to the net banking system so that the customers can easily pay through their net banking. So A is the answer. Chalo. So this is it. NBBL, that is NPCI Bharat Bill Pay Limited, a wholly owned subsidiary of the NPCI, uh, partnered with JustPay to introduce a switch and software development kit for its banking connect platform aimed at simplifying the bank's integration so that if the bank is joining the Bharat Bill Payment System banking connect platform, it was previously known as Bharat Bill Payment System. Okay, so if the banks are joining the banking connect platform, payment aggregator is joining the banking connect platform, payment aggregator will be able to get easier access to net banking solution of the different banks so that it can provide the customers the access so that they can pay through the net banking easily. Now coming to the next one, SEBI has directed providers of significant indices. There is the NSE 50 or BSC 500 index or Bank Nifty, Sensex. So multiple indices are there. So significant indices should register with SEBI within 6 months. Within 6 months, an index is deemed significant if the daily average cumulative asset under management tracking it across mutual fund schemes exceeds what threshold for each of the previous 6 months. So basically, so basically, uh, a index will be considered significant index if the mutual fund is tracking this particular index for the investment done by the mutual fund, and the mutual fund has invested more than 20,000 crores, more than 20,000 crores for each month in the previous 6 months. Okay, so as per the daily average, so 20,000 crore is the answer. So this is the idea. Now this is the most important point. Another most important point here is that if the asset under like if the index is considered significant index that has to register with SEBI, it will remain significant index even after, like let's say it became the significant index because the mutual funds they were tracking this index and they were investing more than 20,000 crores cumulatively for the past 6 months. Okay, now let's say the now mutual funds are not investing as much as per the tracking of this index. Okay, so if the AUM falls below the threshold of 20,000 crore for 3 consecutive years or 6 consecutive half yearly reviews, then this index can be brought out of the significant index only. Now, under the proposed Garud mechanism that has been brought for the alternative investment funds, the waiting time for a regular AIF scheme to launch after filing its private placement memorandum would change from 30 working days to how many? So basically, the alternative investment fund to launch its scheme, it has to file a private placement memorandum that actually informs the investors, because alternative investment fund it is a privately pooled fund that only collects the investment from the sophisticated investors. So this privately placed memorandum informs the investors that okay, AIF wants to collect the money for investing in these particular securities for these particular purpose. Now this PPM has to be submitted to the SEBI, and before it used to take 30 days. Like when the PPM is submitted to the SEBI after 30 days, the AIF can launch its scheme to the investors. Now only 10 working days. Instead of 13 working days, now only 10 working days. wait will be required. So Garud is the green channel AIF rollout upon document acknowledgement. So as soon as your PPM is submitted to the SEBI, so for the regular alternative investment fund, as soon as your PPM is submitted to the SEBI, after 10 days you can launch your scheme now. Okay. But for the large AIFs, for the large value alternative investment fund that collects the money from the accredited investor, and these large value funds, they collect the money from the accredited investors, and the minimum investment is 25 crores. For these kind of AIFs, for these kind of AIFs, accredited investor only AIFs, and the angel funds, they can do away with the requirement of filing the PPM through the merchant banker, and they can, like, immediately after filing their PPM directly with the SEBI without any merchant banker, they can, after filing their PPM with the SEBI, they don't have to wait for 10 days, for any days they can launch their scheme also. So regular AIFs, if they want to file their PPM with the SEBI, they have to do it through the merchant banker, through their merchant banker. Okay. So regular AIFs, they have to file the PPM through the merchant banker with the SEBI, and they have to wait for 10 days before launching their scheme now. But for the accredited investor only schemes, for the large value alternative investment fund that collect minimum 25 crores from their investors, and the angel funds, for these two kind of funds, the SEBI has proposed that PPM can be filed without the requirement of the merchant banker, and just after filing the PPM with SEBI, you can launch your scheme. Now next question is that Sri Lanka's first ever blue bond, that is Sri Lankan rupiah 3 billion issuance by DEFCC bank, was dually listed at Gift City on which exchange? So this blue bond was already listed in the Colombian Stock Exchange. Now it has been listed in the Gift City also, in the NSE International Exchange. So that's why this blue bond is the dually listed bond. It is already listed in Colombian Stock Exchange. Now it is also listed in NSE International Exchange. Okay? Chalo. Now next is, in its proposed overhaul of the municipal debt securities framework, SEBI proposed that the face value of each municipal debt security issued on private placement basis shall be dash as deemed fit. So basically this face value can be the face value. So for municipal debt securities, through this the money can be collected, or this is from May. Like all these articles, I think these are from May, or at least they are covered in the May file of the current app. May or April. Now we have started with April, I think. So no, these are in May. May. Okay, in May files. In its proposed overhaul of the municipal debt securities framework, SEBI proposed that the face value of each municipal debt security issued on private placement basis shall be 1 lakh or rupees 10,000. Only this Sri Lankan wala, it was in March, it was in news in March, but it was covered in May in the file again, because this was again in news. Okay? So though Sri Lanka wala topic came in March in news, but it again came in May. Okay? So it was covered in the May file of it was covered in May file of current app. Okay? And the rest, this is also from the May file of the current app. That is the idea. Chalo. Securities. The SEBI has proposed a series of changes to the framework governing municipal debt securities. Now it has been said that for refinancing existing loan, the municipal issuers, they can release the municipal debt securities. So municipal debt securities can be issued for collecting the money from the investors to refinance the existing loans. SEBI has proposed restrictions on the utilization of issue proceeds not more than 25% of the like, let's say from the municipal debt securities you have collected 100 crores from the investors, not more than 25% can be used for working capital requirement of the project being financed. So if you are collecting money through the municipal debt securities, let's say the government, this local body, the municipal corporations, they are collecting the money. They are collecting the money from the investors, or they are taking the debt from the investors through these municipal debt securities for some kind of dam based project, or for some kind of school project. Okay? Now, to open or to start a school. Okay. Now, if 100 crores have been collected through this instrument, then not more than 25% can be used for the working capital. Okay. Next is the face value of each municipal debt security issued on private placement basis shall be rupees 1 lakh or rupees 10,000 as deemed fit. Now, coming to the next question. Consider the following statements about RBI's revised outward remittance framework. Authorized dealer banks remain fully responsible for FEMA, KYC, and cybersecurity compliance even when using third party platforms. So this is correct. This we have already discussed that outward remittance framework, the authorized dealer category 1 bank can connect with the non-bank entity. Authorized dealer bank remain fully responsible for the FEMA, KYC and cybersecurity compliance. Yes, remittance funds must not at any stage flow into the account of the third party in India. Yes. The remitter's funds should not go to the non-bank entity. Okay. It cannot go to the non-bank entity. If the authorized dealer category 1 is getting the funds from the foreign citizen or from the non-resident Indian, it should directly be transferred to the beneficiary. It should not go to the non-bank entity or the third party in any case. So funds should not flow to the non-bank entity or the third party whose application is being used by the authorized dealer. The relaxation applies to trade-related current account transactions. No, the authorized dealer category 1 banks can only connect with non-bank entity for the remittances. So this is incorrect. 1 and 2 is correct, and that's why the answer is A here. So this we have already discussed. Next is that under the recently signed MOU with the Reserve Bank Innovation Hub, which organization will share mule account related intelligence and suspect identifiers from its suspect registry? So basically, the RBIH and this particular organization have done the MOU so that the organization can share the data with the RBIH and the Mule Hunter AI of the RBIH. RBIH Mule Hunter AI can be used to hunt the mule accounts that are being used for the money laundering or for the whitewashing the black money. Okay, so I foresee that is Indian Cyber Crime Coordination Center. So a Reserve Bank Innovation Hub has signed the MOU. The Indian Cybercrime Coordination Center has signed the MOU with the RBIH. So the I4C will share the information to the RBIH, okay? So that the mule accounts can be identified. Now coming to the next one, OpenAI recently announced the creation of a new company to help organizations AI systems that generate tangible operational impact. What is the name of this company? So basically, OpenAI will help in the deployment of the AI in further areas of a company so that the AI can generate the operational impact. So OpenAI deployment company. D is the answer. So OpenAI announced that it is setting a wholly owned company, that is OpenAI deployment company, which will assist organization in deploying AI systems that generate tangible operational impacts in more areas than they can identify. The next question is SEBI e-settlement guarantee fund norms for commodity derivatives clearing corporation. The modified stress testing requirement now considers simultaneous default of at least how many clearing members. So basically clearing corporations, clearing corporations, they are the intermediaries in the in the capital market domain. It is the clearing corporations that have the responsibility of clearing and settling the trade. So if trade is happening between the two entities, clearing corporation is responsible to clear and settle the trade, but the clearing corporation cannot clear and settle all the trades. So their clearing corporation has many clearing members that are the intermediaries that clear and settle the trade. Now let's say before it was said that if two clearing members are failing, the two biggest clearing members are failing, and 50 and so if the two biggest clearing members are failing, so whatever exposure they have will be transferred to the clearing corporation. And let's say all the other clearing members are also failing, so 50% of their exposure will also be handled by the clearing corporation. So for that, the settlement guarantee fund has to be maintained. So this was not making any sense. That's why the method has been revamped and it has been said that the settlement guarantee fund has to be maintained against the stress test, where it is said that if the three big clearing members fail, then the clearing corporation will get the exposure. So for that, settlement guarantee fund has to be maintained. So three clearing members if they fail. So before, the method was that if two big clearing members, like the two biggest clearing members are failing, so and their associates also, and all the exposure is going to the clearing corporation, as well as 50% of the credit exposure is also going to the clearing corporation if all the clearing members are failing. So for that, settlement guarantee fund has to be maintained, had to be maintained. But now the method has been changed. Now this 50% all clearing members failing simultaneously criteria has been removed. It has been said that if the three clearing members and their associates are failing, the big three clearing members, for that the settlement guarantee fund has to be maintained for the stress that can come in the future. Next is NISM signed an MOU with the Dash to advance corporate governance, ESG, and capital markets. So NISM has signed the MOU with which organization? With the India Institute of Corporate Affairs to advance the corporate governance, ESG, and capital markets. That's it. Sorry. So here RBI announced a switch auction. Basically, RBI is saying that for the government securities that are maturing between 2027 2030, RBI has said that the tenure will be increased for these securities, so that the government do not have to pay in 2027 or 2030. Rather than the the tenure will be 2035 to 2060. So if you want to continue with the government securities, you can bid for the longer tenure. But if you do not want to continue, you want your money back in 2027 or 2028, 2029, 2030, so you can not bid. Okay, so basically this is the switch facility which the RBI is using. RBI has announced the switch auction, converting a basket of bonds maturing between 2027 2030 into longer tenure securities, so that the government do not have to pay in this tenure. Government can pay later on in between 2035 to 2060, but the government will have to continue paying the interest rate, if not the maturity amount. Investors can choose to continue with the government security or they can opt out also. The other things you don't have to remember, just the moto idea was that the switch has happened. Okay. As well as here, one more important point, the minimum bid size has been fixed at 10,000 rupees, and the bids must be in the multiplication of the 10,000. Next, Antariksh. Now we are starting with the April articles. So April and March, because we have already done the monthly revision session, so now we will go fast. Antariksh Venture Capital Fund aims to support startups at which stages? So Antariksh Venture Capital Fund, it is the alternative investment fund that has been launched to support startups for the space technologies with the TRL 4 or higher. Okay, space technologies that have the technological readiness level 4 or higher. So that is the idea. Coming to the next question, this also, like, I have already taken the monthly revision session, so we have already discussed all these articles. So now you see the question and answer the question. Which of the following entities has launched the Indian natural gas derivative contract in collaboration with the Indian Gas Exchange? So it is the NSE that has launched the Indian natural gas derivative contract in collaboration with the Indian Gas Exchange, and which index is being used to price to get the price. So is it CPI, WPI? Is it the gas index? So it is the Indian gas index of India. So, okay. So the Indian prices are being used, gas index of India. So the NSE in collaboration with the Indian Gas Exchange launched the Indian natural gas derivative contracts, which will be priced as per the Indian prices gas index of India, as per the gas index of India. Next, recently Dash has joined the Banking Connect platform to enable faster and interoperable net banking payment based services. So net banking payment based services, which bank has joined the Banking Connect platform to enable faster and interoperable net banking based payment services? So basically, which bank? Axis Bank. Very good. Axis Bank is the answer. Okay. So Banking Connect is an interoperable net banking platform that enables seamless and faster digital payments across banking different banks. Okay. Banking Connect platform has been developed by NPCI Bharat Bill Pay Limited, and Axis Bank has recently joined the Banking Connect platform to enable faster and interoperable their banking based payment services. Next is creditor initiated. So we have discussed the IPC amendment, the Insolvency and Bankruptcy Code. The amendment has happened, the bill has been passed. So creditor initiated insolvency resolution process is initiated only by specified financial creditors out of court with at least dash percentage of the notified financial creditors agreeing to the initiation of the creditor initiated insolvency resolution process. So how many should agree? 51%. And this process should be finished within how many days? Within 150 days. That is extendable by 45 days. That is extendable by 45 days. Now coming to the next question. So I have already taken a session. We have discussed this in the monthly revision session also. Under the SEBI's framework for the past risk and return verification agency, that is under the SEBI's framework of PARVA, which entity has been recognized as the PARVA entity responsible for validating the risk and return claims of the investment advisors, research analyst. So it is Care Ratings Limited, as well as Parva Data Center has been selected as which stock exchange. Which stock exchange has become the Parva Data Center? It is the National Stock Exchange. Okay. So SEBI operationalized the Parva, that is Past Risk and Return Verification Agency. Care Ratings Limited has become the Parva entity to verify the claims of the intermediaries, as well as the National Stock Exchange has become the Parva Data Center. Next, which match the following SEBI digital platforms with their primary function? Subcoms, it is for the communication management of the SEBI. E-adjudication portal by the name itself. Quasi-judicial proceedings. CSAC, that is cybersecurity supervision for the. So first का C, second का B, and third का है CBA. C is the answer. ठीक है. So, Subcoms, it is the single universal platform for communications that has been developed by SEBI so that the communication can be done with the external entities. E-adjudication portal, this is for the proceedings, for the quasi-judicial proceedings that is undertaken by the SEBI. Next is cyber security audit compliance. This is AI-enabled platform for the cyber security oversight. Okay. Next is which two entities jointly organize the Niveshak Shivir? Now we are starting with the March articles. This is the start of the March articles. Only a few questions are left. Which two entities jointly organize the Niveshak Shivir program aimed at facilitating investor services? So Niveshak Shivir program, it is run by IPFA and the SEBI. I hope all of you know. IPFA and SEBI. Okay. I hope whatever you have written is good. I don't know. Under the revised FDI guidelines for investments from countries sharing a land border with India, what percentage of non controlling beneficial ownership is now permitted under the automatic route? So that is the idea. See, the land border countries, for that, it is said that non controlling beneficial ownership is now permitted under the automatic route up to 10%. Up to 10%. Okay. So for the land border countries, this is the most important point here, that the land border countries, the beneficial owner, the real person that is purchasing the ownership under the automatic route should have non-controlling beneficial ownership. Should have non-controlling beneficial ownership from the land border countries up to 10%. This is allowed under the automatic route. This is allowed under the automatic route. Now, what is the full form of Praram? I hope you all remember the full form of Praram. That is very, very important. This was the nationwide awareness campaign launched by the Finance Minister on the Income Tax Act 2025 that started from 1st April 2026. Okay. So Income Tax Act that is applicable from 1st April 2026. So Praram is policy reform and responsible action for Mission Viksit Bharat. Policy, reform and responsible action for Mission Viksit Bharat. So D is the answer. Now next, MANA full form is also important. M, moral and ethical system. A, accountable governance. N, national sovereignty. A, accessible and inclusive AI. V, valid and legitimate systems. Chalo. Next is under the LRS liberalized remittance scheme, how much may each Indian resident remit per year for purpose such as investment, study or property abroad? The same limit that applies on the NSE International Exchange Global Access Platform. So Global Access Platform has been launched by the National Stock Exchange by the NSE International Exchange. Global Access Platform has been launched in the Gift City IFSC. So under the liberalized remittance scheme, I hope you have already done this in the schemes. So up to 2,50,000 per year. So up to 2,50,000 per year. This is the limit for the financial year for per Indian resident, for per individual under the LRS. 2,50,000. Okay. So global access platform. Uh, this you can read about. This is basically the platform when an investor uses the global access platform to invest in foreign markets. They can do so. Now, one important thing here is View Trade. NSE International Exchange has partnered with View Trade, a foreign broker in Gift City, to execute and settle overseas stock trades on behalf of the Indian investors that will invest through the global access platform. Now, coming to the next one, under the Finance Bill 2026, the turnover threshold for startup tax holiday eligibility has been increased from 100 crores to what? Turnover threshold for startup tax holiday eligibility has been increased from 100 crore to 300 crore. So, tax holiday before the eligibility for the startups was only like if they were having the turnover up to 100 crores, but now the limit has been increased to startups that have the turnover up to 300 crores. They also can take the tax holiday. Okay. There is also the on the capital gains, that is through the buybacks. So if the company is doing the buyback, so the shareholders that are having the capital gain, there they will have to pay the additional tax. And what is the surcharge that they will have to pay? What is the amount, what is the percentage of the surcharge that they will have to pay on their capital gain? They will have to pay a surcharge of 12%. Okay. So the bill introduces a 12% surcharge on the additional income tax on the buyback gains that the shareholders are having. Next is under SEBI's phased realignment. Under SEBI's phased realignment framework for schemes exceeding the permitted portfolio overlap limit, what portion of the excess overlap must be reduced during the first year? So I hope you remember that there was the overlap limit, that if there is the overlap that is happening between the sectoral mutual funds or between the thematic mutual funds, if there was the overlap of more than 50%, that had to be reduced. A maximum overlap can be of 50%, and this had to be reduced in a 3-year time period in a phased manner. In the first year, 35% of the excess overlap had to be reduced. Okay. So 50% of the overlap ceiling is there, that if there is more than 50% of the overlap, that has to be reduced. Maximum overlap between the sectoral or the thematic equity schemes, between the equity schemes, there can be maximum overlap of 50% that is allowed. If there is more than that overlap that is happening, that has to be reduced within 3 years. And in the first year, 35% of the excess overlap has to be reduced. In the second year, also 35% of the additional overlap has to be reduced, remaining 30% last year. Now, coming to the next question. Only 2-3 questions are left. Now, try to answer this. Under the revised IPO norms notified through the Securities Contracts Amendment Rules 2026, a company with a post issue market capitalization above 5 lakh crore must make a minimum public offer of. So basically, the IPO norms were revised if the company is having a post-issue market capitalization, market valuation of 5 lakh crore, above 5 lakh crore. It must have a minimum public offer of 15,000 crore. 15,000 crore. Okay. So this is the idea that minimum public offer, minimum public shareholding needs to be 25%. But the big companies, they cannot directly provide 25%. Like the companies with uh, lakhs of crores of their asset valuation, the companies with the big valuation, with the huge valuation, they cannot provide 25% in one go. So for them, there are certain limits have been given that slowly and slowly they can provide their shares, and they can get the minimum public shareholding of 25%. Okay. So these are certain table that you have to remember, that you have to keep in mind. This we have discussed again and again in the monthly session also and in the revision also. Okay. Now, this is it. This was last question. The data is important here. At least read it once. If you are able to remember it in the examination, that is good. Otherwise, forget it. Okay. So minimum public shareholding is required of 25%. But for the big companies, there is some relaxation that is provided on the basis of their post-issue market capitalization, post-issue market valuation, because these are the big companies with huge market valuation. So for them, some relaxation have been provided. So if the market valuation or market capitalization is up to 1600 crore, they need to have the minimum public shareholding of 25%, or more than that already they have to meet the criteria. But for the other companies that have higher market valuation, there is certain other criteria that is given, that they can reach the minimum public shareholding within 3 years. Okay, within 3 years. And for these, for the market valuation, if it is more than 1 lakh but up to 5 lakh crore or above 5 lakh crore, for them, if public shareholding at the time of listing is below 15%, then they have to achieve 15% within 5 years and 25% within 10 years. But if at the time of public shareholding, at the time of release of their shares, if they had more than 15% or more than 15% of shareholding, public shareholding, then they have to achieve 25% within 5 years. For these categories, it is written that if they have the minimum public shareholding of 15%, less than 15%, then they have to achieve 15% within 5 years and 25% within 10 years. But if they have minimum public shareholding of 15%, equal to or more than 15% at the time of listing, then they have to achieve the 25% within 5 years. Chalo. Now, FSDC, the meeting happened of the subcommittee of FSDC. So you can read about it, nothing much here. Basically, the static is given that the Financial Stability and Development Council was set up by the Government of India in 2010. The FSDC is headed by the Finance Minister. The subcommittee of FSDC, it is headed by the Governor of the Reserve Bank of India. In the Financial Stability and Development Council, the regulators, the chairman of the different regulators are present, and there are all the other members like important members, finance secretary, revenue secretary, secretary of the department of economic affairs. So they are the members of the Financial Stability and Development Council, which is headed by the finance minister. Subcommittee of Financial Stability and Development Council is headed by the governor of the Reserve Bank of India. The subcommittee meeting has recently happened. The 33rd meeting of the subcommittee happened. Okay, the basic discussion happened about the global and domestic macroeconomic and financial sector developments. That's it. What you have to remember is that who is the head of the FSDC, who is the head of the subcommittee of the FSDC, when was the FSDC was set up? In 2010. That's it. After the 2008 global financial crisis. Any confusion? This is it. Chalo. Annotation PDF एक तो गायब ही हो गई है for the half of the session. I don't know if I will be able to retrieve it. I will try, but don't know. For the rest, annotation PDF, I think in the course it will be provided, but in the Telegram group, only the non-annotated PDF will be provided. Anyway, the annotations are not required because this is not a discussion. This is a marathon session that happened. Now, the discussion was just on the broader terms. Chalo. This is it. Thank you, everyone. Thank you for joining. And I hope you like the session. I took the efforts of bringing like the important points that I found, and from January and February also I tried to bring the important articles for the RBI News tab. So I hope you like the session. Chalo. Even like I'm also not feeling very well today. Thank you so much. Chalo. So do download the PDF. It will be provided in the Telegram channel. So thank you everyone. If you really like the session, comment down below. Thank you.